give them cash,
Yeah.
and you do it
It's a great
immediately. That's the way to do this kind of thing.
We've been saying this all week. You don't want that cash to go to the insurance company for the test, right?
Yeah,
How
or
much
some-
responsibility, how much
some
responsibility does the
bureaucrat.
private sector have to support?
If you
So I
look
think
at
the private-
if you look at the Great Depression, for example, we had a lot of fiscal stimulus and the programs that went in and the bureaucracies, and you get what is called the ratchet effect. Those programs, we still have them. The Great Depression was a long time ago.
Steve, hold on, Steve. You're making some good points. Hold on. Let me just say, I totally agree with Steve. Checks to households ought to be a top priority. And by the way, you know who did that last was Bush 2 in 2008. So that ought to be a bipartisan thing. But yeah, look, the insurance companies, I think that they ought to step up. This is a national emergency on the healthcare side. And we're lagging behind other countries in this regard. I also think that if people are facing eviction because they've missed a couple of weeks of work, that we might have to ask landlords to step up. I think the private sector has a role to play here.
Guys, thank you very much. Good to talk to you both. Good to see you again, especially
Thank
Jared. We almost shook hands.
I know, I came close there.
Hard habit to break. All right, meantime, pharma giant Eli Lilly working on a treatment for the coronavirus. Our Meg Terrell joins us with the latest efforts alongside a special guest. Meg.
Well, thanks so much. And that special guest is Lilly Chief Scientific Officer, Dr. Dan Skovronsky. Dr. Skovronsky, thanks for being here this morning.
Great, Meg. Thank you. It's my pleasure.
So tell us about this collaboration that you announced last night with the biotech company AbCellera. You're actually deriving antibodies from somebody who survived COVID-19 to make a potential treatment?
That's right, Meg. We're really pleased to have the opportunity to collaborate with this company, AbCellera, who's just been hugely innovative and moving in with incredible speed. They obtained a specimen from a patient, as you said, one of the first in the United States who had coronavirus and then recovered from it. Presumably, the reason they recovered is their immune system was able to react to the virus. So AbCellera was able to isolate cells from that patient's body, identify the immune cells that were making antibodies, screen individual antibodies for their reaction against the virus. And now we're collaborating with them to turn some of those antibodies into drugs that we hope to be able to test in patients.
And your timeline for this, potentially 4 months until you get into human clinical trials, that seems very fast. Tell us about that timeline.
Yeah, Meg, you're absolutely right. It is. A project like this in another disease area could reasonably take years to go from starting a project to testing it in patients. This is faster than we've ever gone, probably faster than anyone's ever moved. We're pulling out all the stops. This is a critical health crisis for the world, and Lilly's doing what it can do to make a difference. So we have incredibly aggressive plans. Every day is mapped out from now until this summer, when we hope to be testing this in patients just a few months away.
And you say in your release this could be used both as a potential treatment, but then also as potential prevention. Tell us how that might work.
Well, we'll have to see. It depends on the clinical data, of course. But our goal is to be able to use these antibodies in patients who are exposed to the virus. For example, it'll neutralize the virus particles and help them clear the disease. Or you could even consider using this at some point in the future in a population that hasn't yet been exposed, but perhaps is at high risk, say the healthcare workers who are at the front lines of treating this disease. Could this be used in a way to prophylax them from getting it? There's a lot to learn here and a lot of risk in an early stage project, but we're incredibly excited and really privileged by the opportunity to try and help out in a disease like this.
And given the scale of how big COVID-19 already is and how big it could potentially get, what kind of scale do you see in terms of being able to ramp up? I mean, these are antibodies from one patient. How many patients could you potentially treat with those antibodies?
Yeah. Well, that's one of the important roles we play, Meg, is to ramp up the production. So we isolate the clones from the individual patient. We can genetically modify them to improve their properties. And then we put them into our manufacturing plants to scale them up millions and millions fold so that we can have enough to treat patients. We've cleared out capacity, if this works, to be able to proceed to the clinical testing and then, of course, to scale up beyond that if we have success.
Well, Dr. Skovronsky, we'd love to stay in touch with you as you proceed with this work. Thank you so much for joining us this morning.
Yeah, thank you, Meg.
All right, Carl, back over to you.
All right, Meg, thanks so much. Let's get over to the CME group and get the Santelli exchange. Hey, Rick.
Hi, Carl. All right, let's get right into it. We're going to do the 3Ds. 3D outlook of the week. data, debt, dollar. We've seen data. And everybody's been giving me a hassle as I walk around the trading floor, what may be the last day for a while. Whether it was claims down 4,000 to 211, NFIB small business sentiment index solid at 104.5. University of Michigan took a bit of a breather, but 95.9, just the lowest read since October. Listen, many say, well, it hasn't caught up to the economy. Listen, I'm a pragmatist. It's February data. There was a lot of people talking about these things in February. The economy's still holding up better than many people think. And we know negative issues are coming with regard to data and when small business and all the issues that they catch up. All right, second D, debt. Listen, we had $78 billion worth of debt. We had 3s, 10s, and 30s. They weren't terrific auctions, but we moved all the paper. All I could think of is, you know, when you have $4.50 gas, try selling a Hummer, okay? Off the runs, I get it. You know, we've gone through a period of years and years, quarters and quarters, to pack this stadium. You know, Steve Leisman, 3 times the size Treasury market first of the crisis. What, we're going to open the doors and empty all this out in 3 sessions? Of course not. We had intraday lows of 24 on Monday and Tuesday. 31 in 10s. What was it? 69 in 30s. We're multiples of those. Listen, I understand putting grease in the gears. I'm not sure I understand 100 basis points of easing. And quickly, the dollar is doing phenomenal considering its bounce. It's going to be very susceptible to overseas issues in emerging markets. Carl, back to you.
All right, Rick, thank you very much. Meantime, virus fears taking a toll on New York City real estate. Not surprisingly, our Robert Frank has the latest on that. Morning, Robert.
Carl, yeah, virus fears hitting both buyers and sellers in New York City real estate, a market that, of course, has been in decline for 2.5 years now. There were 44 open houses last weekend that were completely empty, so not a single person showed up. That represented 13% of all open houses. Average attendance there down 27%. That's according to data from Fritz Friegen at Halstead. Now, Friegen's saying if buyers feel that values of real estate will further depreciate because of the virus and financial instability, they will postpone decisions to buy. Meanwhile, on the seller side, they're reluctant to put their apartments up for sale. Some are even pulling those listings because they don't want strangers touring their apartments. Now, March is always the strongest month in New York for listings. Last year, listings grew 9% between the start of the year and mid-March. This year, during that same time period, they're only up 2%. As we mentioned, Manhattan real estate now seeing 8 quarters of declines due to an oversupply and those SALT tax changes and the mansion tax. This is really the third punch after the 1-2 punch of taxes and oversupply. Guys, back to you.
All right, Robert, thank you. A couple of quick bits of news here. New York Governor Cuomo says their state's opening the first drive-through coronavirus testing facility, and the president says he will have a news conference today at 3 o'clock. The topic will be the coronavirus. Dow's up 525, basically cutting the early gains in half. S&P 2547, Squawk Alley starts in a few moments. Good morning. It is 8 a.m. at Adobe headquarters in San Jose, California. It's 11 a.m. on Wall Street, and Squawk Alley is live. Good Friday morning. Welcome to Squawk Alley. I'm Carl Quintanilla with John Ford at Post 9 of the New York Stock Exchange. Morgan Brennan heads our coverage back at CNBC headquarters. Bulls trying to hold this bounce after the worst day for stocks since 1987. The five big tech companies, Apple, Facebook, Alphabet, Amazon, Microsoft, lost more than $400 billion in value on Thursday. The Treasury Secretary, Steven Mnuchin, joined us earlier this morning on Squawk on the Street. Take a listen.
The president is looking at a major stimulus package, whether it's through the payroll tax cut or whether it's through another means of delivering liquidity to hardworking Americans. We've announced what will be about $200 billion of liquidity through delaying IRS payments. So hardworking Americans who have tax payments due or small and medium-sized businesses can delay them. I can assure you we will use whatever tools we need to make sure that the industries that are impacted by this get through this. This is a short-term issue, maybe a couple of months, but we're going to get through this and the economy will be a little stronger than ever. You know, I look back at people who bought stocks after the crash in 1987, people who bought stocks after the financial crisis. For long-term investors, this will be a great investment opportunity.
Kirk Hartman of Wells Fargo Asset Management joins us today, and John Rutledge of South and Odd. Guys, good to see you. Thanks for your time, as always.
Morning, Carl.
Kirk, you got the Treasury Secretary talking to us about liquidity. The president reportedly meeting with testing executives later on today. FDA approving this high-volume Roche test. How many constructive things are happening? What more do you need to hear?
Well, there are a lot of constructive things happening. I think this is all great news for the market. But as we've spoken about before, this is a medical crisis primarily, obviously with financial implications. So what I'm looking at is how much money goes to the medical sector and specifically to our hospitals because, well, I think the financial markets are certainly going to recover and there's great long-term value. I think the critical thing is our emergency wards, our ICUs, and, you know, those type of things. So, you know, in addition to financial stimulus, I think we need help for our medical sectors.
And John, weigh in, if you will, on where we are just from a market perspective as well. The human toll and tragedy and concerns continue. But there's a question now about if you've got cash on the sidelines, when do you get in? How much do you get in? I know you're thinking about this. How are you approaching it?
You know, it's a very difficult time, Carl, because one doesn't want to go around saying if you had raised cash a year ago, you would be in a good spot right now, because they can't. People who did are looking at a tremendous opportunity to buy things at big discounts. But in that case, you only want to buy the things that are going to survive and prosper, which means the very best names with no leverage, with no tight debt covenants, with no immediate refinancings, et cetera. So I haven't sold a share of anything in a while, and I'm just tickling with buying things. Our biggest enemy right now is our emotions. Our emotions are right now either screaming sell or buy. Neither one of those is good advice. What we want to do is to preserve capital at this point. It's a very difficult time to be an investor. The same things, by the way, go not only in the stock market, but in the bond market and in private equity and in real estate, where the same forces are at play. It's a time for older, cooler heads to calm people down, I think.
Yeah, it would seem that nothing's immune, especially looking at all the volatility we've seen across so many different asset classes just in the past week alone. Kirk, the fact that we do seem to be poised for a more coordinated response from the federal government, whether it is the Fed stepping in with that $1.5 trillion injection into the financial system yesterday, the fact that you do have this fiscal bill this potential first phase fiscal bill moving through Congress right now, or those comments from the Treasury Secretary on our air earlier this morning. Is this enough? Is this the type of response now? Are these the type of policies that are going to do enough to quell investor concerns and potentially stop what could be a recession?
Oh, I think they will. Look, I can't predict that volatility is going to end. I think the volatility will continue. But one thing I've been very pleased about is the Treasury market. I think it's actually very interesting that Treasury yields are holding in and actually have come up, which I see as a good sign. So I think the support for the Treasury market has been terrific. And I think a lot of the measures that are being taken in terms of the fiscal side, and I hope we see more, I think it was great for the market. So I think actually the markets are functioning pretty well here. Certainly we've got a way to go, but so far so good in terms of, if I knew what was going to happen, I think we would all be pleased. And the markets have actually behaved fairly logically, as hard as that may seem.
Yeah, John, I just want to get your take, given the fact that you do have deep insights on China, as we start to see more supply chains come back online. I think just today you had the report that lowest tally of new cases confirmed in 24 hours in China since January 8th. As that country comes back online, what does it do to global industrial activity?
Well, China is definitely now stabilizing. The supply chain issue from that end is actually getting somewhat better. Now we have an issue from our end because you can't push components and parts through shut down factories. And as my colleague said, this is a medical issue, not an economic issue. But I think China at this point, I think the most destructive thing you're seeing is the blame game between Chinese officials and American officials. It's very stupid. It's very destructive. This is a disease. We need to do everything we can to contain it. We need to do everything we can to try and lubricate the economy, too. So, send people $1,000. The Fed should open the gates, et cetera, et cetera. That's not going to solve the problem. In terms of will it stop a recession, I think no. Recession means people are not working. I think people are going to be not working for some time here and in many other places. But that's not the real issue. The issue is, to me, when it crosses the threshold from being a macro problem, spending, supply chain, et cetera, to being a non-price rationing credit crisis. The biggest issue there to keep your eye on is the corporate bond market. There's a huge corporate bond issue in China with dollar-denominated corporate bonds and a banking system that's not really suited to providing working capital to private companies. In the U.S., we're having heavy outflows from the corporate bond funds at the same time as the bulk of corporate bonds have the lowest possible investment grade rating. If they lose one rating, mutual funds will be forced to sell them by prospectus. So that's the issues. So avoiding a 2008, a Lehman Brothers, keeping credit flowing, keeping the banks open, that's really the issue. And right now, that's not going very well.
Guys, thank you. Good to talk to you both. A lot to handle and process today, as we do expect to hear from the president at 3 o'clock. Good to see you both, Kirk and John.
Thank you.
Good to see you.
And we are getting some news on Grubhub. Kate Rogers has that for us at headquarters. Kate.
Hey there, John. Grubhub announced it is temporarily suspending collection of up to $100 million in commission payments from impacted independent restaurants nationwide. The fees will be suspended for qualified independent restaurants. Now, the company hasn't broken down quite yet how it will be qualifying those. In addition, it said it's created a fund that will enable proceeds from its Donate the Chains program, where diners round up their bills and then donate the remains to go toward charities that support restaurants and drivers who are being impacted by the COVID-19 crisis. Grubhub says it and Seamless have been raising more than $1 million every month for that program. Now, Grubhub will work with city officials to identify the organizations that are going to be able to use these funds moving forward. Guys, back over to you.
Yeah, this is going to be one to watch. Kate Rogers, thank you for bringing us that news. With major live events and conferences being canceled, what would happen if the New York Stock Exchange floor actually shut down? Bob Pisani has the answer for us. Bob.
Morgan, the NYSE is now allowing most personnel to work from home. The people here on the floor, the people behind me, for the most part, they're not NYSE employees. So yesterday I asked NYSE President Stacey Cunningham what would happen to the floor if the event someone tested positive for coronavirus here. Let's listen in.
If there is an outbreak, we can clean the floor and reopen pretty quickly as well. So that's something we're not planning to close the floor at this time. But as you mentioned, we could, and we could trade fully electronically.
Now, the NYSE has had a business continuity plan, BCP, in place for decades in the event the floor needs to close for a flood, a snowstorm, or any other disaster. But this plan would allow the NYSE to trade electronically without the floor open if it needs to. The market makers and the floor brokers who are here can continue to participate in that electronic trading, though there may be some limitations around the closing auctions, for example. The NYSE has closed many times over the year, notably 4 months at the outbreak of World War I in 1914. For the death of John F. Kennedy in 1963, 4 days right after 9/11, and for 2 days after Hurricane Sandy in October 2012. With these cases, the markets, however, were closed. In the situation now under consideration, there's the possibility of closing the floor, but keeping markets open electronically. That's a little different. Now, in the event that some or all the people working here need to self-quarantine for whatever reason, traders tell me that many teams have already started splitting up. Some working from separate offices in order to avoid having an entire firm self-quarantine, a model that is being adopted by many companies that need to keep up and running in some capacity. In the meantime, both the CBOE options exchange floor and the CME trading floor have been temporarily closed. And John, I could tell you this, Mr. Secretary Mnuchin was on this morning making it very clear he wants the markets to stay open. So you're hearing from people at the very top, a lot of pressure, keep the markets open, and the NYSE will be doing a deep cleaning of the entire floor right after the close tonight. Back to you.
All right, Bob, thank you. And coming up, Adobe CEO Shantanu Narayan as that stock soars after earnings. That's right after this break.
ED.
Welcome back. Adobe shares soaring this morning, up 9.5% after posting record revenue, though the company did see an impact on profit moving forward due to the outbreak of the COVID-19 disease from the coronavirus. Adobe CEO Shantanu Narayan joins us now in a CNBC exclusive from the company's headquarters in San Jose. Shantanu, great to see you.
Thanks for having me, John.
I want to get to earnings specifically in a moment, but I can't help but think You became CEO years ago just in time to face the financial crisis. As we're getting into this period dealing with this novel coronavirus, how is this similar? How is it different for you from the CEO seat?
Well, John, having been here 20 years, I used to think that I had seen it all, but this is clearly unprecedented times. And I think like all responsible business corporations, what's front and center for all of us right now is foremost the well-being of our employees and our customers. And so focusing on what we are doing as it relates to working from home, ensuring that we have the travel restrictions that are appropriate at this time moving forward, and ensuring business continuity as it relates to making sure that our customers who want to engage with digital, that has really been all-consuming, which is different from anything that we've experienced before.
Now, on the call last night, you said that among the impacts that you expect to see, they are enterprises deferring booking decisions, delaying consulting services implementations, reducing marketing spend, consumers reducing spending in countries more adversely impacted by this COVID-19 situation. How well do you think you're able to gauge, to estimate the impacts of those things, given the lack of tests here in the U.S. and some of the spotty data we're getting? Is it still kind of day-by-day, week-by-week evaluation?
Big picture, though, John, I mean, we had an outstanding quarter, and we had our first $3 billion quarter. What we said on the call, if you take both our businesses, on the digital media side, we had record new ARR for what is a Q1 in $400 million. And I think we saw little to no impact as it related to how people were transacting with us on Adobe.com. On the digital experience side, which is the enterprise business that you're alluding to again, greater than 20% bookings growth, subscription revenue grew north of that. But with the travel restrictions, what we are seeing, and in all my conversations with CEOs around the world, what they're focusing on is first employees and making sure that their employees are safe. But all of them are also asking us as Adobe how we can help them once they focus on the employees. How do they engage with their customers digitally? But yet we said that as it related to our Q2 numbers, we would expect that with the travel restrictions, with some of the high-touch requirements that happen in enterprise, we would expect to see some weakness as it related to people delaying maybe their digital purchases and the services implementation. And so on that side, we factored all that into our targets. But overall, I would say that Adobe had an outstanding quarter as it related to Q1. And long-term, nothing changes. The imperative to engage digitally is only going to get more important. But I think all corporations are first trying to figure out how they operate digitally and then focus on their customers.
And I do want to give some time to emphasize that as well. Your stock is up 9%, and that is for a reason. And I want to ask, your cloud positioning, does that help ameliorate the potential downside in a situation like this? Meaning, when people do have to work from home, if they're using Adobe software, how easy is it for them to be productive on that software from home? I know a lot of your customers have set up limits on exactly which machines people can use the software on. Are you able to make adjustments to that in a secure way so that some of those employees perhaps can use the software on different machines as appropriate? And are those conversations taking place?
That's a great question, John. And for somebody who's followed us, as you know, our business is relatively predictable. The move to the cloud enables us with 90% recurring revenue, and I think you saw that both in Q1 and you're going to see that in Q2 as it relates to the core profitability of the company. But we have leaned forward with education specifically to answer your question on how we're engaging with customers. Given every single institution around the globe is moving to online, what we've already decided to do is to allow people who had access to Creative Cloud or Document Cloud in the lab to have access to it at home. So, we're going to be lean forward. We're engaging with every one of our enterprise customers also in terms of an outreach and asking them how we can help them during this time. But I think all responsible corporations like Adobe are going to look at it and say, let's take the long run, but let's make sure that our customers are not impacted during this trying time.
Shantanu, tell us about productivity during this work at home period. I mean, I know many people know that you have been building out headquarters in San Jose, several towers you've got downtown there, partly for the purpose of productivity, getting workers together to build and troubleshoot this software. When people have to work remotely, how much do you have to slow down your timelines on how you roll out improvements, new features in your cloud software, and how much does that potential slowdown or hit impact you if this goes on for several months?
Well, John, we've had this debate incessantly in terms of, is it more productive to be in a closed office, an open office, whether it's more productive to be at work or to, work from home. And I think we're going to all, as a globe, understand and get more data associated with it. My sense is that on the engineering side and the product side, more of the product people, especially the engineers, are accustomed to working from home. And so I think that will continue unabated. But there is some element of when you're walking down the hallway and having a really interesting debate, and that causes new innovation. I think we're all going to try and find out how to keep that productivity and creativity alive as we transition to a completely digital environment. And I think most companies are going to see a little bit of a hiccup, but it's going to be nice the next time I meet with my engineers and I can actually give them some real data on what we are seeing in this situation.
But Shantanu, that raises a great point, and you're so good at seeing around large corners. To the degree that we do come back to work and congregate again as Americans, as Europeans, as Asians, you name it, in a year or whenever it is, do you see that coming back fully, or has there been a structural change in the way we are going to relate to each other as coworkers?
I think there will be some fundamental structural changes that are going to be long-reaching. I think as it relates to business continuity planning and making sure that people can work remote, I think you are going to see some fundamental structural changes. But I think most companies are going to look at this and say, what did we learn as we had everybody work at home, and how do you make that a part of the normal workforce? And how do you balance, the beauty of having everybody in a room when you can be creative and you can really brainstorm with how you can use more technology? I mean, at Adobe, we've doubled down on making sure people have access to this technology wherever they are. We are going to be, as soon as I finish this, do my first all-employee meeting, as well as my first all-VP leader meeting, completely virtually and completely electronically. And as you know, we're doing our digital summit that we normally have in Vegas, also electronically. So we're all going to learn from this process, which I think is a good thing. I mean, we all know that technology has significant benefits, and as long as we can use this effectively. But I think there will be long-term structural changes in how we work.
Yeah, it's going to be really interesting to see how all of that plays out, Shantanu. You touched on this a little bit, but I just want to dig into it further here, and that's the fact your CFO said our recurring revenue model and real-time visibility we have into our business uniquely positions Adobe to manage through an uncertain environment. That real-time visibility right now is so important, especially given the fact that, at least from a macro perspective, so much of the data now seems kind of old. The fact that there's so much uncertainty around, say, the earnings picture from a market standpoint. If you had to break it down across the different sizes of customers, of businesses that are using your products and services, different regions around the world, what are you seeing in terms of that real-time visibility right now?
Morgan, that's a great question. And we have this thing that we call the data-driven operating model that enables us to understand every single day what the customer funnel is. And what we said was that on Adobe.com, both in the entire Q1 as well as the first few days of March, we've actually seen little to no impact. In China, where we have a smallish business as it relates to our Creative Cloud, and we sell through resellers, that saw a little bit of impact. But on the other hand, in Italy, where we have a relatively healthy business, while the reseller, in other words, people engaging directly in physical locations, was impacted a little bit. We saw additional strength on Adobe.com. And so I just continue to think as long as consumer sentiment is positive, that people will engage more digitally because people are at home, they're going to be creative, they'll want to be entertained. But it's changing, and we get visibility country by country in terms of what's happening because we not only process trillions of transactions on behalf of our enterprise customers, but we see that directly. And it's fascinating to see how this has actually moved in conjunction with the outbreak.
And Shantanu, you and Adobe are in the top tier of fast-growing, large technology companies. So I wonder, from your perspective also as CEO, what are you still spending on in this environment?
Well, we just, we've always focused on how do we continue to build the company for the long run while navigating the current environment. And so I think, as I think about that, fundamental innovations in product, we will continue to invest in that. We will certainly look at geographies and say, do we disproportionately double down on some of these places? And I think the other thing that's top of mind for us right now is when we have these solutions like electronic signatures, or what we are doing to enable productivity when people aren't in a physical location, how do we get the awareness out? So I think much like a number of our customers are asking us, we're probably going to spend a little bit more on awareness because we feel like stronger companies can actually grow stronger during this period.
Okay, and finally, to be clear, you're still hiring and across the board or in specific areas?
We're still hiring across the board, but all of these interviews are virtual. And so part of the challenge that we have is how do we know whether it's a robot on the other side or an AI or an actual individual? So it'll probably get delayed a little bit. But big picture, I think we're just going to continue to focus on it. But we'll monitor the situation in real time.
All right. And monitoring your stock in real time, you are up more than 9%. After earnings, Adobe CEO Shantanu Narayan with us exclusively. Thank you.
Meantime, China is tapping its leaders in tech to help contain the spread of the coronavirus. Our Eunice Yoon explains from Beijing. Hi, Eunice.
Hi, Carl. Well, titans like Baidu, Alibaba, and Tencent are testing out new technologies aimed at getting people to feel more comfortable leaving their homes again.
China is encouraging tech firms to experiment with all sorts of technology to help people cope with the epidemic. In big cities like Beijing, some of the most useful are apps that track confirmed cases. This one, by Tencent and state paper, The People's Daily, detects where the clusters are so I can figure out whether it's safe for me to go out and where. Contactless technology is being pushed hard right now. Anything that helps people get things done without having to have others around. At this supermarket, the main way to pay is with self-checkout. All I have to do is open the app, get my payment code from Alipay or WeChat, and scan it, and I'm done. More buildings are also asking for health codes. These codes were created by the government with technology from Alibaba and Tencent. Once I register, my information gets linked to a database, and I'm categorized as either green, safe, yellow, a risk, or red, a serious risk. The codes are meant to help office buildings and residential areas keep track of who might be sick, but they're also raising privacy concerns about what data is being collected and how much more control it gives to the government.
For now, though, more people are eager to get back to their day-to-day lives, so they're willing to embrace these somewhat and potentially intrusive as well as overbearing technologies. Guys?
Eunice Yoon, thank you for bringing us the latest from Beijing. Professional sports leagues around the world suspending their seasons in the wake of the coronavirus. Eric Chemi has the latest. Eric.
That's right, Morgan. So the big story that came out this morning, golf's most prestigious tournament, the Masters, announced it is postponing this year's event. It had been scheduled for mid-April, just a month from now. That news coming after last night's news that the PGA Tour canceled its current event after just one day and has shut down all events for the next 3 weeks. And just a short while ago, we also learned the Boston Marathon, which had been scheduled for April 20th, that would be postponed into September. Overnight, the XFL, which Vince McMahon just launched this year, canceling the rest of its entire season. They were just halfway into the regular season. The brand new league saying it would still pay its players for the missed games. Its season would have ended in April. Leagues teams and business partners, they're all now trying to figure out a lot of unknown questions that they don't have the answers to. Mark Cuban says he's looking into ways to pay hourly workers who might not get paid during the work stoppage because there are no games. Kevin Love from the NBA's Cleveland Cavaliers announced he's donating $100,000 to arena workers, and he hopes others will follow. Executives I talked to said despite complex written agreements and a lot of legalese, the leagues and the partners, they have an understanding that they are going to need to work together right now. They'll have to figure out make goods for lost media exposure, lost events, all these canceled things, even if it takes many years, because on a long-term contract, they've got a lot of time to make up the difference of what gets lost right now. But for now, NASCAR, IndyCar, and the UFC, they still plan to hold their events. The Olympics is still on schedule for now, but as we know, things are changing rapidly every few minutes here. Guys, Carl, back to you.
That is for sure, Eric. Thank you, Eric Chemi. Dow up 376, basically 1,000 points off the opening highs. Let's get a news update with Sue Herrera back at HQ. Hi, Sue.
Good morning, Carl. Good morning, everybody. Here's what's happening at this hour. Iraqi soldiers surveying the damage at the site of a U.S. airstrike that targeted Iranian-backed militia weapon stockpiles. A top U.S. general says the threat from the Iran-backed militants remains high. Here at home, Disneyland is open for one last day before it temporarily shuts down because of the coronavirus. Disney plans to reopen the original Happiest Place on Earth next month. Disney's cruise line is also suspending its operations starting tomorrow. Disney World in Florida is set to close on Sunday. Walgreens and Kroger have expanded their purchase limits on some health products. Walgreens is limiting sales of items including disinfectant wipes, hand sanitizers, masks, and gloves. Kroger has placed limits on the number of cold, flu, and sanitary products per order. And a preliminary study from China is taking a look at how the coronavirus affects children. 10 infected children were assessed, only 7 ran a fever, and none showed other symptoms seen in adult patients, such as muscle aches, headache, and pneumonia. And experts say the milder symptoms may make it early detection and isolation of children much more challenging. You are up to date. That's the news update this hour. Back downtown to Squawk Alley. Carl, I'll send it back to you.
Sue, thank you very much. Let's get a look at the best performers on the Dow this morning as we're at session lows. Dow's up 262. We're being held aloft by JP Morgan Chase, Boeing, Intel with percentage gains that would have shocked people about a month ago, but today seem pretty moderate. Back in 2 minutes.
needed.
Welcome back to Squawk Alley. Stocks are at session lows right now. The major averages are all up for the first time in 3 days, but the Dow is off by more than 1,100 points right now. It's currently trading up 270. The S&P is up 1.4%. 2515 is your level there in what has been an absolutely historic week for trading. Jefferies' Brent Thill and Megan Hsu of Wilmington Trust join us now to break down all of the market action that we have been seeing. Thanks for being with us. Megan, I'll start with you. The fact that we are fading the gains right now, what is that indicating about the market at these levels?
Well, we would expect continued volatility, and I wouldn't be surprised to see a couple of really big up days like we've seen over the past week, because volatility we tend to think of as very negative, but it is two-way. We are still cautious on this market. We think this has a ways to go before it will be fully played out. We've seen some significant monetary policy response so far. We're waiting for fiscal. But unfortunately, what we really need is time. And that's not something that a policymaker can give us to see how this virus plays out. And we're still on the upward trajectory here in the U.S. So we think that there's more volatility to come.
So Megan, where's an investor to hide right now? I mean, how are you consulting your clients in this time of great volatility?
We're telling our clients to be underweight equities, but not sell out or do any knee-jerk, panic-based selling. When you do that, it is that much harder to get in at the right time. And there's so much focus on where is the bottom, when will markets go back up again. We've seen about a 25% peak to trough drawdown, which is right in the median of historical recessions. So we're pretty much there in terms of the market pricing in a recession. There's really nowhere to hide in the equity market in this type of market because even the defensives are getting sold off. But what we've seen hold up a little bit better has actually been what worked over the past year or so. Some of those growthier names, higher quality, earnings stability, those types of areas of the market. We still like some pockets of healthcare. We still like consumer staples and some consumer goods because when we do get through this, and we will get through this, we are going to be sitting at low interest rates, low mortgage rates, and we think that consumers came into this in a very good position. So consumer-based products and goods will be poised to rebound on the back end.
Yeah, and of course, low gas prices too. Brent, some of those growthier names are names that you actually cover. I see here in the notes that you're lowering estimates across the software industry. 40 companies that you cover by 1 to 3%, that no one is immune here. That being said, where do you see more safety within your coverage universe, and where do you see the coronavirus and the broader macro economic effects having a bigger impact?
Yeah, short term, I don't think we see any safety. We still think there's probably 1 or 2 more rounds of number cuts to come. The 1 to 3% cut that we made could be a 5 to 10%. No one really knows, again, depending on the impact. But, just driving into San Francisco today, it feels like a Thanksgiving day. No one's on the roads. I mean, it's eerie. And I think when you think about many of these companies that closed business at the end of March, that have a direct sales force, it's going to be really tough to get deals done. So I think the first quarter is going to be really difficult. It's going to bleed into the second quarter. We have companies like Expedia and Booking are pulling guidance for the year. So I think right now the answer is no one really wants to do anything. We do like Intuit, given the safety in the tax business. It's a very well-run company. We like Adobe. The CEO was on earlier this morning. We think they're in a great position as a monopoly in the creative business. We think Microsoft will come back. But again, they're still at risk with their enterprise business. They had already pre-announced 1 month left into the quarter. So, no one's immune. It doesn't matter where you're at. But there are some great stories that are off 20 to 30+% that we think investors will come back to. So if you have a 2-year lens, we think you can take advantage of some of these. But short term, I think we still haven't probably seen the bottom yet.
And Megan, I would think a lot of investors, particularly those who might be rebalancing their retirement portfolios, but a lot of investors have a longer window than 2 years. So why not buy now? You mentioned that we're down about 25% from the highs on the S&P. That means 33% upside to get back there. I doubt many people think that we're likely anyway to drop another 25% from here. So that means it's a decent time to buy, right?
For a long-term investor, you're getting some very attractive opportunities. We do not know how long this is going to play out, but if you do have a long enough investment horizon, absolutely, you're getting some attractive entry points for clients who have portfolios that have moved and significantly drifted from their targets. We are absolutely recommending to rebalance. And for clients who have cash on the sidelines, you're getting the opportunity to buy in at market levels that we haven't seen since 2018. We would say be patient. Don't throw it all in at once, because we could have another 5 or 10% down to go in the market. But we absolutely don't think you should try to be too cute in timing the bottom. And if you have a long horizon, we think we're going to get through this, where we'll have a contraction in the second, possibly third quarter. But we're expecting at this point a rebound in the fourth quarter, such that U.S. GDP is probably going to be about 1% for the whole year.
Brent, excuse me, Brent, just to go back to your point, the fact that we saw Slack report earnings, stocks trading lower right now, soft outlook, slower growth, that coronavirus could hurt demand for products as companies cut back on tech spending, I think took some investors by surprise, since it's sort of been seen as one of those stay-at-home stock names within playbooks right now. You can make a similar argument for a name like Grubhub, which is suspending collections of restaurant commissions as well. Some of these names that have been, at least in recent weeks, tossed around within the tech and internet space as names that could actually be advantaged by the situation we're seeing in people staying at home. Are there actually some hidden costs, unexpected headwinds that could materialize here that haven't been taken into account?
Yeah, I mean, I think, look, no one's immune. I mean, everyone's created this list of stay-at-home names, you know, Activision, Electronic Arts. You're going to play more video games, Amazon, more deliveries to your home, using Zoom video conferencing, using Slack to communicate. There's a stay-at-home portfolio, but I think, as we've said, you know, no one is immune. You look at Slack this morning, the magnitude of the move, even after the stock had retraced from the high 20s to the low 20s and now back into the teens. You know, again, it just goes back to our thesis that right now, there is really no great shelter in tech, and we think tactically there's more short-term downside, but there's some great franchises, and I think ultimately we'll hopefully find the bottom of the next quarter. And again, it just depends on your horizon. I think many have said that if you look out 2 years on a 25 to 30% correction, it's really hard not to make money in past recessions or past pullbacks that we've seen. If you have that duration. So I think you have to, again, bet long-term right now. And there are some great bargains that are coming into sight. But we may have, again, one more number cut going into this quarter. Again, look at Adobe, great franchise. They brought their direct selling business and digital experience down into the low teens. It's the lowest growth rate we've seen in that business since, I think it was 2016. So, you know, this is unprecedented. So no one really knows, again, where the numbers are going to bottom. We think there's one cut that we've had. We've got probably 1 to 2 more to come. So we're getting closer, but we're not probably quite there.
Yeah, we know there'll be a bottom at some point. It's a matter of when. Brent and Megan, thank you.
Thank you.
Thank you.
And let's get a quick check on the markets. I want to mention the Dow at one point was up around 1,000 points. Now it's just under 150 points, less than 1%. Same for the S&P and NASDAQ, both up less than 1%. The rally has faded. We'll have to see where it goes from here. For now, let's get to Rick Santelli at the CME for the Santelli Exchange. Rick.
Thanks, John. And I'd like to welcome the bond man himself, Jim Grant of Jim Grant's Interest Rate Observer. So, Jim, I can't think of a more appropriate person to have on a day where, after quarters and quarters and quarters of accumulating high leverage debt, triple B debt, having the Fed and central banks have rates low enough that any form of debt and yield look good, covenant light, and now all of a sudden we open the exit doors. What do you see going on? Describe how the liquidity is, what the Fed's done, your thoughts.
Well, liquidity is this thing that is there when you don't actually need it, and it's certainly not there when you do need it. The Fed seems to be at sixes and sevens, not knowing quite what to do except to do more of it. But I see something circular in all this, Rick. To meet a crisis, our central banks, the governments foster credit formation by suppressing interest rates, doing QE. But that increment of debt impairs, as it's, so to speak, because we're all epidemiologists now, it impairs the corporate immune system. So the next time there is an actual business cycle problem, businesses are weaker than they might otherwise be, thanks to the medicine that was so liberally dispensed to them to meet the crisis. And so we come to the present day. There is more debt than ever before in corporate debt as a percentage of GDP, and the quality of that debt is weaker than it has been, at least since 2007. And to meet this difficulty, governments the world over are borrowing more, and central banks the world over are intervening more, printing more, and suppressing more. One does wonder where it ends.
Now, with regard to where it ends, next week we're going to have a Fed meeting. Now, we've seen Christine Lagarde, for the most part, hold pat. I was very impressed. We've seen Carney and the Bank of England be a little more aggressive. We somewhat expected that post-Brexit. Your thoughts? There's calls out there that they should go to 0 to 25 again. What do you think, especially under the terms of $1.5 trillion liquidity thrown at the gears?
Yeah. Well, I think the Fed will act and try to do something aggressive, perhaps 0 again. I want to commend Christine Lagarde on her first statement before she was reminded that it was not going to pass muster. What she said was, we are not here to manipulate or to do something with credit spreads. And she had to walk that back because the Central Bank of Europe, the European Central Bank, is indeed there to manipulate credit spreads. So I think it's important that central banks, whatever they do, at least don't forget that interest rates are prices, and these prices mean something. And I think not a little of our difficulty now is that the prices have been skewed and manipulated and distorted such that debt is much more abundant and much lower quality than it would otherwise have been, except for the central bank's exertions.
Well, in the final minute we have, here's my big problem, Jim, is that we need to make sure the average person, small businesses, don't get tsunamied by the economic repercussions of what may yet come. But on the other hand, many of these entities that are going to be getting help just love leverage, and probably instead of trying to deleverage, they're going to take any type of help or liquidity given them and re-leverage. How can we keep that from happening again, but still address the issues we need to today?
Well, Rick, I think we need a different race of human being for that one. I think people respond to incentives, and the incentives have been and remain, for some part, to borrow more and to lever more. Although at the margin there is a wave of deleveraging, so it's rather mixed. But we'll know more in 10 years, I say, Rick.
I got you. Well, listen, Jim Graham, thank you. Nobody knows the future, but nobody knows about bonds in the present better than you do. Thanks for joining me today. Rick. Morgan, back to you.
Great conversation, Rick Santelli. Thanks for bringing it to us. Take a look at the biggest leaders on the S&P this morning as we fade the gains and the index slips back below 2,500. Oracle, Coty, H&R Block leading the way. Don't go anywhere. Squawk Alley returns in just a few.
again.
Welcome back. There's a look at the Dow, up 1339 at session highs right after the open. We've lost a lot of it. The DAX was up 9%, has now, did flip red before the close, and the VIX is now up a touch above 77. Our next guest is part of the fixed income team over at JP Morgan that's been ranked #1 by Institutional Investor for over a decade. Their head of interest rate strategies, Jay Barry, who joins us this morning on the CNBC Newsline. Jay, thanks for your time. Happy Friday.
Happy Friday to you. Thanks for having me.
What has been the JPM playbook so far, and is it playing out in these early days the way you saw?
Yeah, our view is that the aggressive action the Fed took last week by cutting 50 basis points intra-meeting has set the stage for another aggressive set of cuts. The other times where the Fed has cut rates inter-meeting, it's followed up with another aggressive cut at the next meeting. So we're looking for the Fed to actually lower rates by 100 basis points next week by the Wednesday meeting. One, because of the follow-up on the intermeeting basis, but second, because in a world in which interest rates are so low, the Fed is supposed to use its bullets rather aggressively. So we think it makes the case to aggressively go to zero next week. And if you look at how rates markets have reacted, the Fed funds market now is expecting the Fed to cut rates to zero very shortly, and the way the yield curve is steepening seems to be reflective of that as well.
All right, so once we hit the lower bound, then what other tools would you expect them to go to first?
Yeah, when you look at the Fed's playbook, it's told you that it will go to zero quickly. It will then use forward guidance to convey to markets that it will remain on hold as long as it needs to. And I think the thing that they're looking at now are probably inflation expectations, because we know market-based inflation expectations have fallen pretty sharply. They're sitting near their lowest levels of the last decade, and the Fed is trying to sort of maintain credibility for its inflation targets of saying that it will not raise rates until those inflation expectations and inflation are back above target is a credible sort of way it could sort of convey this to the markets. And then finally, the question is whether the Fed uses asset purchases again. You saw what the New York Fed announced yesterday. It took its T-bill purchases and pushed them out the curve to sort of alleviate market functioning stress. But the question is whether it makes larger use of asset purchases in order to help reduce dislocations, which are historically high in the Treasury market right now.
Jay, there are people who say that the half-point cut from the Fed was too soon, that it didn't seem to have that much of a market impact, and will question how many resources the Fed will have remaining really should more shocks occur. Why are those people wrong to be concerned about that?
Well, one, I think the Fed has told us that in a world in which it doesn't have much room to ease, it's got to ease aggressively. And we at JP Morgan think right now that the U.S. economy is in recession in the first half of the year. So they're justified in acting aggressively. And yes, they've got limited tools with respect to traditional monetary easing, but they've got other non-traditional tools that we just talked about. But I think this also makes the case that you need to see a policy response from others. And we've made...
Jay, I apologize. We're just getting a tad of breaking news. For that, we do want to turn to our Eamon Javers. Eamon?
Yeah, Carl, that's right. We're told by NBC News, which is confirming some reporting that's been out there, that the president does intend to call a national emergency later today. He's called a press conference for 3 p.m. here at the White House without releasing what the topic is. NBC News now reporting that that will be a national emergency declaration. What we believe is happening, Carl, is that the president is likely to invoke the Stafford Act here. That's a procedure that was initially started back in the 1970s to deal with national disasters, and it unlocks funding from the federal government for FEMA to respond in localities that have been hardest hit. In this case, the possibility is that you're looking at a national declaration of disaster, which would affect every state. We'll wait and see. Yesterday, the president said that he may do some of the more minor things under his emergency powers. We don't know exactly what he had in mind there. So there might be something short of a full national emergency declaration coming from the president of the United States. We're working to get more, Carl, and as soon as we have those details, we will get them to you.
Eamon, if we do actually get an emergency declaration from the president here, I mean, we had a healthcare CEO on our show yesterday who was talking about what that could mean from a healthcare perspective and from a test perspective. Do you have any sort of sense about what that could do from a regulatory standpoint, and I guess more specifically in terms of speeding up the process of being able to get tests into the hands of doctors and healthcare facilities?
Well, I don't. And one of the things aides here have been talking about is the idea of unemployment insurance under FEMA. FEMA runs a program for people who've been displaced by a natural disaster. That could be sort of refashioned here to apply to some of the people who've been displaced or will be displaced by the virus. That might be one of the more important elements of this for the economy. But we just don't know the full scope of what the president has in mind here, and we're going to have to push for some more details from behind the scenes.
All right, Eamon, thank you for that. That's been a flurry of headlines and really just the past half hour as we await news regarding the White House and the Speaker on a response bill. The president's going to talk, as Eamon says, at 3 o'clock. Macron, Mike Santoli, tweeted a few moments ago that there'll be a G7 video conference on Monday to discuss coordination around the globe. And we'll see to the degree we get any kind of surprises on Sunday.
Yeah, exactly. I mean, I think the market, it's certainly wounded, it's fragile, it's very sensitive to any sense of whether there's going to be policy response commensurate with what the market's afraid of. I do think there's impatience on the congressional side, and you saw that wear through the morning. Without making too much of each tick-by-tick move, it's not terribly unusual to have a super big bounce at the open after a very oversold market and then kind of find your way after that, maybe give some back. So I don't think this is a verdict. But by the way, just with that news that Eamon reported that it would be an emergency declaration, the market has picked up again. Perhaps there was a little bit of, we don't really know what we're going to hear at 3, and this is more palatable than perhaps some other options.
And Mike, what I was watching, the VIX was above 77 for a while there, and now it's gone negative. The VIX has only closed, what, above 70 4 times?
Yes, exactly.
One of which was yesterday.
Highly stressed, very distressed markets. It didn't exist in 87, the VIX. The old version of the VIX, they backtested, it would have been over 100. But beyond that, it's 08. That's basically your example in terms of these levels. And it's very hard to sustain it. In fact, if you closed above 70 or so on the VIX, you've always gotten a very, very powerful bounce that maybe didn't even mean that much. So that's why right now it seems as if the rallies are kind of guilty until proven innocent when you've been in this condition. But really the makings are there because it's such an utterly washed out market.
Mike, the major averages are all still higher, although well off the highs of the morning. The exception to that, though, is the Russell 2000, which has just turned negative, and which we've seen sell off pretty furiously in the last couple of weeks, down 34% over the past month alone. What are the small caps telling us right now?
They're telling us a few things, Morgan. One being there's a lot of financial stocks in there. There's a lot of indebted stocks in there that are not really core profitable when you really get down to it. So it's sort of the lower quality version of a lot of the things that the market's afraid of. So it's staying away. Obviously, they would mostly benefit from a quick reacceleration in the market, less able to weather a recessionary period. So all those things are in the mix, I think.
And then finally, maybe not nearly as important, Bolsonaro of Brazil. Yeah. His Facebook page, countered all kinds of reports, says he has tested negative.
I don't know whether we're going to be parsing these things for days and weeks to come, but
let's see how we can avoid it.
Yeah, exactly.
We'll see. Monday's going to be key, obviously, as we get closer and closer to Wednesday's Fed statement and presser. Try to rest this weekend because we're going to need you all back here on Monday. Let's get to the judge.
Carl, I appreciate it so much. The final day of a tumultuous week sees stocks trying to bounce. Welcome to the Halftime Report. I'm Scott Wapner. Good to have you with us today. In just a little while, we're going to be joined by the billionaire investor Carl Icahn. Do not want to miss that. Meantime, the investment committee is here too. Joe Terranova, Josh Brown, Jenny Harrington is the CEO and portfolio manager at Gilman Hill Asset Management. In New York for us today is Keith Banks. He's Bank of America vice chairman. He is also head of the Investment Solutions Group. Let's start where we always do. Our eyes firmly on your money again today. At least now there is green on most of the board. It is not as green as it was earlier. Nonetheless, right now it is a positive day for the Dow, up 400 following the biggest decline for stocks since the great crash of 1987. The Russell has gone negative. Josh Brown, it's been one heck of a week. So what are you thinking about today after we've given, we gave up almost all of the 1,000 point bump? we're still hanging on to a few hundred.
So
what now?
So a couple things. One of the points I've been trying to make on the show recently is that security selection is not going to be the answer to how much pain you're going to take in a moment like this. And that was proven this week. The XLU, which is the utility sector, which normally in any market correction is not going to be disastrous, was absolutely disastrous. I'm not even giving you the drawdown from the peak. I'm just going to tell you this week, the XLU is down 19%. So I think that that's indicative of what we've seen across the board. There really has been nothing safe. And yesterday, of course, historic day, at 3:30, there wasn't a single green S&P 500 stock. So security selection has not mattered. And I come back to this idea that only diversification, owning both stocks and bonds, and only portfolio construction is going to be the answer. The other thing I want to tell you is what I told my clients last night in a letter, which since we founded the firm, I've only written one 3 times. And what I basically said was that without a doubt, we know the headlines are going to get worse. They're not going to be better. Like this weekend, they'll be really bad, and no one will be able to access their investments and move things around. And they'll be worse when we start testing more, which hopefully happens. You want to see higher totals. I hate saying this because then you know that we're doing more tests. So if you know the headlines will get worse, what is the only question you need to ask? You need to ask, at what point does the market stop reacting every time a negative headline comes out? Only then will you know that we're getting closer to the end, and we are not there.
So, very good points. I want to read some of the commentary from the street today and get your reaction to it, to the point of how much downside is really left, Joe, in this market. Morgan Stanley's Mike Wilson weighs in on that question and says we're now trading slightly below our downside case on the S&P 500 and believe it is time to start adding to equity risk for long-term investors. Wells Fargo today says put new money to work. With the 16.5% week-to-date slide in the S&P, the risk-reward now appears more attractive. I follow that up with one more point, and that comes from Howard Marks today in a letter from clients near the end, quote, all great investments begin in discomfort. One thing we know is that there is great discomfort today. So what do you do with that?
What you do with that is I think you begin to understand that this is going to be a process of which equities are going to be bottoming. With that, I think you begin to slowly buy into this market. You first ask yourself this question: can I endure another 15 to 20% lower for the equities market? If you can, you then ask yourself, will I get that back? And I believe, excuse me, I believe the answer to that unequivocally is you will get that back. One of the most important conditions in the market to watch for, Scott, is the positive correlations between oil, yields, the U.S. dollar, and equities. In the last couple of days, you're beginning to see those correlations break. That's positive. You're seeing a lifting in yields. The other thing is that understand this is, as we've said, a biological crisis that needs an economic activity freeze. You are beginning to get to that point. You're getting to a very cathartic moment. I think it was very real and personal last night, as I said to you before the show. No sports on television, just kind of sitting around. Now everyone's understanding it. And I think you're going to be getting a much-needed, coordinated communication response from fiscal policymakers, from global central banks, and from healthcare officials. So if you can endure the potential for more downside, yes, absolutely. I believe you want to buy because you're going to get it back.
All right. So, Jenny, Barclays asks, are we there yet? Are we near a bottom?
I think we've got to be pretty close. And I think that because I look at what S&P earnings started the year at, we trimmed them in-house, we trimmed them by 5% and kind of stress tested with different multiples. Goldman put out a note yesterday, or sorry, a call, where they also said we expect at this point that earnings on the S&P will be down 5%. And so if you take that earnings where they started the year, cut it by 5%, put a multiple on it where we bottomed in 2018 at 14.5 times, cut a little off of that, we're pretty near a bottom in the 2,400 range on the S&P 500.
Okay, so JP Morgan, though, says we're going to have a recession. In fact, we're having one, right? You're going to get -2 this quarter in growth, and you're going to get -3 next. So if that comes to fruition, does your calculus change?
Not necessarily. And this is where I go to Ed Yardeni, who's one of my favorite strategists, who says we may have a recession this quarter, next quarter, the quarter after, but then we could have serious rebound in the fourth quarter. And so if something like that plays out, the market, the market's going to anticipate 6 to 9 months in advance and could actually
Even if you don't have a recession statistically,
No, I get
it's
your
going to
point.
feel
Of
like
course, it's
one.
gonna feel like
Yeah.
one.
You're going to have one. And to Jenny's point, let me just say this very quickly. To Jenny's point, you are absolutely going to have industries that are already in recession and what feels like depression. That's no matter what the national data says across all regions and across all industries. So that is already in progress. It's not something that could happen. And everyone's expectations have to now factor that in. You cannot have the expectation that even if the stock market rebounds, the country's not going to be feeling it.
All right. So, Keith Banks, you've heard the commentary. We're going to lean on you now for your years of expertise in these markets to tell us what you're thinking and what you think the average investor needs to think about and do today.
Well, look, Scott, I think the biggest challenge right now for investors is we're still dealing with what we call the known unknowns. We don't know, and I think Josh made some of this point, how much longer the coronavirus will be spreading, what the number of additional cases will be, what the death rate will be. That's number one. Until we'd have a better feel for that, we don't know what the impact on the global and U.S. economy will be. And until we know that, we're not going to know really where the earnings picture comes to pass. So I think we have to get more insight. We are in a bear market now, by technically speaking. And so I think it takes 3 or 4 months typically for a bear market to find a bottom. So I think we're getting closer, but I think there's still some time to come. And we're going to have a prey to some bad news. The point was made, right? There are going to be more cases once the kits are available. I think companies have to still come out and adjust earnings downwards. And I think economic activity will still be adjusted downwards also. So we're probably a bit early. But, I would also say you got to remember, if you go from the 30s on, if you had missed the 10 best performing days in each decade, your return over that period would have been 91%. Had you stayed in, your return would have been 15,000%. So trying to zig and zag in and out of the markets doesn't work. So I wouldn't be selling here. I might be holding off a bit to put more money in, but you don't want to be trying to do the day trade game.
Hey,
it doesn't
Keith,
work.
I think that's a really important comment. The majority of people should not be out there thinking that they can play those zigs and zags. The only place where people can successfully do that, miss the worst days and still do really well, is probably on Twitter. I know they're really good at it there. I want to ask you about bear market rallies because I think this is the big danger for mom and pop and for retail investors who are important to everyone on Wall Street. So when you think about, let's say, the 2000 to 2002 example, we went back and looked. There were 6 separate bear market rallies. The weakest one was 7%. 3 of them went up 20%. And even even having those bear market rallies, you still ended up at the end of the thing down 50% in the S&P before the final bottom. We are going to have those face-ripping moments in this market going forward, even if it's a recession, even if it's a bear market. But wouldn't you agree the big danger is taking those moments and getting all bulled up as though the worst is over?
Yeah, I agree, Josh. I mean, right now you have to fight the natural gravitational force that comes from a market in this mode. When it's zipping around, you almost feel like you're being pulled in to do something, and that's usually the worst time to, in fact, do something. So I agree with you. You got to figure out, how do you start to get a sense of where we are from an economic standpoint? What are the translation into earnings going to, in fact, be? And then you decide, when are you getting close enough? Now, I think, there's some underpinnings are forming. Whether it's you look at the yield on the S&P versus the yield, on the 10-year Treasury, the earnings risk premium looks good. Multiples are coming down further. I think the stage is starting to get set, but I think it's a bit early for the play to begin. Yeah. And I also want to see more coming in from a fiscal policy standpoint and a monetary policy standpoint to make me feel better.
That's the thing, all right?
Yeah.
We're still waiting. We're still waiting on a lot.
Right.
To come to make people feel, Jenny, better about getting in. A lot of the investors I talk to don't sound like they're, ready to jump in. I don't even know with a full foot, thinking about a toe.
Well,
but even that's skittish.
Yeah, I think the feeling is interesting, and I thought that was so interesting, and it really hit me strongly yesterday when the Fed announced this huge package of money, and it didn't do anything. And I thought, you know what? People don't want money. They want, to Keith's point, they want information. I'm not even sure at this point if bad information will be bad information. I think we just want information because we all know as investors, if you have information, if you have data if you can trust, if you have stuff, you can move on and you can move forward. With respect to investors getting in, one of the interesting things is because this happened so quickly, I don't even think it's a question of getting in. I think it's a question of not getting out. And so I've spent the last week and a half just talking to every single one of my clients personally and taking the time with them. And the conversation's been very different than this conversation was in December 18 or in 2008, 2009. The conversation is, what can you do? You know, I'm down so much. What can you do?
Well, there is a legitimate question as to whether, you know, at some point, if you're a long-term investor, Joe, as some of the notes suggest today, that you do get in, even if you risk seeing more downside.
Yeah.
So maybe it isn't the bottom. No. But at some point, you have to have that conversation with your financial
That's actually
advisor.
how most people are investing through dollar cost averaging and retirement accounts. That's actually what the lived experience of most of the viewers watching this program now are doing.
That's exactly at the top of the show what I said. If you believe that you could endure another 15% lower, then you're going to be getting in at these levels. You're going to be looking at a historic day like yesterday when the market's down 10%, and you're going to be finding opportunities. I also think it's important to understand that a lot of the economic numbers we are going to see in the coming quarter, Scott, they're going to be very distorted.
They're going to look like typos.
Incredibly distorted, and they're not going to be actionable to trade off of. You would think naturally the labor figures will contract significantly. You might not see those labor figures contract significantly if you get a fiscal response that shows you're going to get some support for small businesses. So you might not see that. So what we are pricing in right now, what we're pricing in right now, okay, is freezing economic activity. And that's actually the right behavior from a healthcare standpoint to mitigate this. So how much of the market has already been priced in terms of understanding that economic activity is going to slam shut? That's the question.
I was going to say, you know how you know that's the right move to make, by the way, canceling South by Southwest, pushing off Coachella, no Boston St. Patrick's, on and on and on. You know how you know that's the right move? Because it's going to cost people billions of dollars. And they would never do it unless it was the absolute right thing to do for the intermediate to long term. Anything that painful financially, no one's doing that for no reason. If we're putting ourselves through that, to Joe's point, you're going to see comps that look ridiculous, like almost like somebody splatter painted on the spreadsheet. Yeah. But those will be healed relatively quickly. They're not a forever situation.
Keith Banks, I mean, you do at some point have to make a calculus. Right, everything's based on a calculus or a probability when you're buying or selling a stock. Where you think things are going to go, you have to try and decide whether you think there's going to be a quick snapback after the pain that we're going to endure for maybe a couple of quarters and maybe more. Nobody knows. But you still have to decide at some point, based on whether you would buy this market now or not, as to whether you're going to get some sort of V-shaped snapback or a longer period of time because the pain is going to be deeper than people think.
Yeah, that's right, Scott. I mean, if you wait until you have too much certainty, the market will have well discounted that, and you would have missed it. No one's going to pick the bottom, so you can't try to be clever enough to try to do that. You got to take a long-term point of view, which is the point that Joe made, which I agree with. But look, I think what you got to do is my guess will be it'll be more like a U-shaped recovery than V-shaped, because I think there's going to be a lot of additional information coming out over the course of the next couple of 3 months. A lot of it will not be very positive, back to coronavirus cases, back to economic data probably showing weaker than not. I don't think we're not forecasting a recession yet at Bank of America. We're not saying we think we're going into one, but we're getting closer. But I think this is going to set the stage, especially to begin to move money from fixed income into equities. Look what the S&P has done over the last 21 days. By the way, it took us 21 days to go from a bull market to a bear market. That's the fastest move ever.
Record.
The last time even record. The closest was 1929 when it took 42 days to go from a bull to a bear. So I don't think it's nice to think we're just going to bounce out of this. We have a lot more information to process. Some will be better, some won't be so good, but it's going to set the stage for a point you can move money, especially out of fixed into equities, increase your equity exposure, and then I think at some point it'll be safe to go back in the water.
Keith, what do you make of the premise that there'll be a tremendous rebalance opportunity here? If you had a traditional 60-40 portfolio coming into this quarter, you're going to, at the end of the quarter, look at it and say, whoops, okay, now I've got a 52% in equities and 48% in fixed income, and the need's going to be there just by the nature of the construct of the portfolio to rebalance.
Yeah, no, it's a great point, and I think a lot of investors are looking at that right now because that's the math, right? Now, I think people would have begun that process already, Joe, but I think what's happened up until yesterday, there was no liquidity in fixed income. You couldn't transact in size if you needed to. So I think as liquidity starts to come back, and hopefully through the Treasury actions, that'll be starting sooner, not later, I think you can begin to do that. So to your point, you need to make a lot of shifting from equity to from fixed to equity just to get back to a level where you thought you were, not to mention if the valuation becomes much more compelling on the equity side to begin to make even more of a bet potentially. Because the other thing to think about, assume we don't go into a deep recession, what this can do is almost reset the clock again. So we get a couple of down quarters maybe, but if this is the pause that refreshes, why can't we go with rates where rates are, where inflation is and is going to be? Why couldn't we go on then for another few years? And with valuation now coming in, that could be, and with monetary policy, fiscal policy, hopefully coming in a powerful way, this could create another very significant buying opportunity that people look back and say, boy, I wish I was fully in when that began to happen.
Yeah, just the tricky part of that is, paradoxically, stocks have come down 24% from their highs. They actually could be more expensive today than they were 3 weeks ago, depending on what window you're looking at for earnings. Not over 10 years, but over, well, I mean,
that's the key, though.
We know the E is nowhere near reality, even though we've seen estimates come down. So it's interesting, like, how far forward can you look as an investor?
I just feel like the likes of, and we'll end here. Keith, thank you so much for being with us. We'll talk to you again soon. Stay well. And
My
we'll
pleasure.
See,
thank you.
We'll see you soon. I know we will. And that goes to the point maybe that Howard Marks is making. And the people who say things like this and have tons of experience in looking at markets that are disjointed and may become even more so, that maybe we look back, a few months from now and we say, okay, Howard Marks said this, all great investments begin in discomfort. One thing we know is that there's great discomfort today. Put some reality to perhaps where we are, perspective on how to think in the big picture as the great ones tend to do, and they do well or they wouldn't be considered great.
I think that's a great observation. And again, I look at yesterday and just the amount of communication personally that I received from people wanting an explanation of, hey, what went on today? I think yesterday, for the very first time, the fire alarms were really going off. And I think even today, the construct of the way the market is traded lends itself to policymakers understanding this weekend they have to be aggressive in their communication. We came out, the Dow was up 1,200. That's not a good recipe. You actually want to see the Dow fade today and get policymakers uncomfortable and not just looking at that tape and saying, okay, we think things are going to be okay. Put the pressure on them to communicate quickly. Do it this weekend.
So let's drill it down to exactly what all you all are doing as we speak, because you guys are doing stuff in the market. Jenny, you sold General Mills.
Yep.
And you have bulked up some of existing positions using the sell-off to your opportunity.
Right.
In where?
So in which positions?
Yeah.
Okay, so I really went across the board portfolio by portfolio, but on Monday, I sold General Mills, which has held up completely. I mean, it faded the last couple of days, so thankfully I sold it Monday. And then I used the cash from that to bulk up positions like, and I know this is controversial, but like Targa, like Sabra, like Dow, which was down 20%. I bulked up things like Lamar Advertising, which is, the big billboards that you see when you drive down the Jersey Turnpike. You can look back, just touching on Lamar, for example. You can look back to 0809, their revenues were down 12.5%. And meanwhile, the stock's down 35% right now. So to me, that was a good trade. What I did yesterday was I teed up positions, and I didn't put that money to work. So I have another position in the portfolio that's being sold. It's already been sold, so it's trading at its sale price. It's like having cash. And so I put in the sales for that and got ready to buy 2 new positions. I didn't pull the trigger yesterday. I'm not pulling it today. But I think it really goes to Howard Marks's point, which is you make good investments when you're at maximum discomfort. By the way, when I bought General Mills, it was in December of 2018, right? And that's really uncomfortable. But if I look back to all the best investments that I've made since I've started, they've always been at that point of maximum discomfort. And I was telling my colleagues, when I was buying things on Monday, the word that was in my head was, scared but courageous.
And I don't think I've heard, by the way, I don't think I've heard anybody on this show today say, buy stocks today. Now's the time to buy stocks today. You may pick some individual things here and there, but nobody is suggesting.
We're talking to millions of people that have all different requirements for, future savings, and it's hard to just give blanket advice to anyone that could be watching.
Well, I think we're trying to, discuss maybe what the strategies are. What the thought process
I'm a buyer.
is in this sort of situation.
This is what I do. I glance in the rearview mirror, which is to say, when we set the allocation for this client, was it set correctly? Yes. And did that conversation involve what happens to my portfolio in the worst of times? Yes, it did. And then I look very far out to the future, and I look 2 years or 3 years down the road, and I know that we're going to be okay. And I know that these positions that we're adding are going to be okay. And then it doesn't matter if we nail the bottom or not. My partner at work always says, no one rings the bell when we hit the bottom. No one rings the bell. But what I do know is that the prices are compelling now. And to Joe's point, it doesn't really matter if you're down 10 or 15. No, it does matter. If you can handle being down 10 or 15%, be courageous.
So, Joe, very interesting, as I look at the notes today, you initiated a position in Delta Airlines, which is, one of those businesses and sectors at the epicenter of all of this where you're going to feel maximum pain for a while. You see pictures of flights are empty. Dr. Fauci last night on television said he wouldn't go on a leisure flight right now.
Nor would I.
I asked Gordon Bethune last night on our 7 p.m. special. He was skittish about doing that as well. So why Delta?
So in looking at the airlines, it was either United or Delta. I did want to take a small position on the belief that there ultimately will be a recovery. And in an odd kind of way, you look at your portfolio and you analyze it and you continue to say, where is the risk? And actually, when I look at my portfolio right now, the risk would be a sharp recovery, and I am underinvested in that recovery. And in particular, I think a lot of that recovery could potentially come from the airlines. The airlines have done an incredibly good job just positioning themselves for this moment in terms of raising cash. Cash levels are at very strong levels. So I think they've done a good enough job. And to me, Delta in a very small position is the right way to do it. There were some other moves that I made there as well. But a lot of the moves that I'm making, again, it's on the belief that I'm observing what was a very healthy patient that very quickly went into the ICU, and I'm looking at these vital signs and saying, okay, there are some things where I think the vital signs are getting a little bit better. It doesn't mean the patient's going to get out of the ICU, but I do see some improvements.
Goldman Sachs?
Goldman Sachs is a position that, as you know, in January, when financials were deteriorating, I was talking about yields coming down, I had gotten out of it. Well, if you're getting out of Goldman Sachs after earnings somewhere around 230, 235, buying Goldman Sachs is 160. I'll take the pain if there's further downside on that position.
Josh, so you've been doing a bunch. You've been putting in orders. Some things have gotten hit. Some things have not.
Still waiting on some.
Where are we?
I got filled on Berkshire Hathaway yesterday, right around where it's trading today. Never thought in a million years it would happen. Put that in probably around 225 on the initial dip in late February. Hey, imagine you can get Berkshire Hathaway under 200. Well, I got it almost under 180. So that's an investment. It's a stock that I had been in throughout my life, on and off. It's underperformed the S&P over the last 10 years, as value stocks have. I think there's a tremendous amount of optionality given the balance sheet, given how much cash they're holding. And to Joe's point, if you think you want some sort of a call option on the recovery in arguably two of the hardest hit sectors, banks and airlines, well, you're getting them both by owning Berkshire Hathaway. He's the largest shareholder in many of the major banks and all of the major airlines. So put that aside. I bought Starbucks yesterday at 70 and again today at 60. Never thought in a million years. It's a $100 stock. I got out of Dunkin' Donuts weeks ago looking for an opportunity to upgrade my portfolio. Huge upgrade. I don't care if Starbucks goes to 50. I'm 43 years old. I intend to hold the stock. I'm pretty sure people 20 years from now are going to be drinking coffee. So will it be a rough couple of quarters? Yeah. Are you telling me none of that is now discounted in a price that's come down 40 points?
Right. And you bring up such an important point of it doesn't matter if you nail the bottom exactly.
I have no interest in that.
As long as you're directionally accurate.
I have no interest in that. So
you're going to make a lot of money.
So that's important. So and then there are opportunities where Slack is a good example. Reported a great quarter last night. Nobody cares. They threw it out this morning. I got a chance to own more under 20. Good for me. I'm a long-term holder. Shorter-term trade in Gilead. I'm not a biotech person in general. I think it's interesting technically. This is one of the highest RSI stocks in the entire market right now. This is a company that continually comes up in terms of being part of the solution. I have a fairly tight stop here. It's maybe I'll be in it for a cup of coffee. Maybe it works out and I hold it. But that's the type of thing that I'm trying to do. Again, I'm in my early 40s. Let me stress early part. I'm not using this money next week. What am I going to do, sit here and cry? No. I'm investing for my future with money I don't plan to be using in the next few years. And every time I've done that over the last 20 years, I've looked back and said, thank God I did.
And I like to think of myself, as a risk manager right now. No energy exposure at all, okay? Oil should be at $25. It's not. I took a small position in Hess just so I have that energy exposure.
All right, we'll talk to somebody coming up who has some energy exposure. Straight ahead, billionaire investor Carl Icahn joins us. Do not miss this interview, and do not miss our special report tonight on CNBC, Markets in Turmoil, 7 p.m. Eastern Time. The halftime is back in 2 minutes.
Wentworth.
I'm Rahel Solomon, and here is your CNBC News update at this hour. 2 countries are looking to expand their stimulus programs aimed at fighting the economic impact of the coronavirus. Japan's government plans a 3rd emergency economic stimulus plan. That could be worth more than $95 billion and could be implemented as early as April. Reuters is reporting that Canada is considering a multi-billion-dollar aid package for industries hardest hit by the coronavirus. So this would include the tourism and hospitality sectors. Report coming as Canada's parliament has shut down for now more than a month to slow the spread of the outbreak. And staying in Canada, Prime Minister Justin Trudeau and his wife Sophie remain in self-quarantine after Sophie tested positive for the coronavirus. She became sick when she returned home from a trip to the UK. And apparently, even the top of the world isn't immune to the coronavirus. Nepal has now closed all of its Himalayan peaks, including Mount Everest, this climbing season because of the outbreak. Everest is on the border between Nepal and China. China has also closed its side of the mountain. You are now up to date. That is your CNBC News update at this hour. Scott, I'll send it back to you.
All right, we appreciate that. Thanks, Rahel. All right, let's now welcome in our special guest today. Carl Icahn is the billionaire investor back with us from Florida today by phone. Carl, thanks for being here.
Yeah. Okay, Scott. Good to talk to you.
It's been quite a while. We have not heard from you in a long time, and I know you've been bearish for a long time. Now that we've had this tumultuous week and what is a tumultuous time, how do you feel about the market today, and what does your positioning look like?
Yeah, look, I've been pretty bearish for the last few years, so I've kept most of my stuff pretty well hedged. But now I think it's reached a point where there are some companies that are just sort of given away. You know, I just think it's in a state of collapse. But some of these companies, I like to think of some of the ones that I'm in. I don't like to think of them that are awful cheap. See, they're very cheap. So I'm not quite as bearish as I was, even though I do think it probably has a longer way to go down.
By how much more do you think it has to go down? Are you already putting your toes in the water, looking at some of the opportunity that you see and buying some stocks?
Yeah, I am. I'm certainly adjusting my hedge. Just doing this and doing the hedge, and I think that happened with other people that do these hedges. There was I sort of miscalculated in that fact that I thought that my long positions were on one side, the shorts on the other, and we do it in very large numbers, pretty large numbers, billions of dollars, and S&P short. So we look at it all the time, but right now, as you know, I bought Oxy and I've been buying some Hertz. We put out a 13D on that today. Mm-hmm. So we are sort of dipping our toe. But I think back to that Seeking Alpha or Discovering Alpha show we did 5 years ago. I was thinking about it last night, knowing what was going on, and what I said then, I think, is still pretty accurate. Yeah, we sort of had. I had a cartoon with Larry Fink, and
we remember it well.
Was pushing the party bus over the cliff, and I think part of this is definitely from the fact that there's just too much money floating around. So all that money floating around over these years is there, waiting for some match to ignite it, and the match has sort of been this coronavirus. So you have what you have here is a situation where you have a lot of companies out there that overborrowed, and to some extent people have overborrowed. So you have this money, and with that money they went out, say, and bought stock, a lot of buyback. And then what happens to them now when they can't even, make the earnings? Well, you can't make the earnings to pay back all this money they borrowed. So they were sort of on a party. And I remember having that argument with Larry Fink. I respect Larry Fink, but they were saying, "Oh, that can't happen. Nothing can happen." I think part of this is the index funds, where you have a lot of people. Think of 29. Where you had margin calls, and they just threw the stocks on the fire. Nobody cared. They just wanted to get the guys that gave the margin want to get their money back. Well, now you think of it in a different way. So you got people across the country, well-meaning people, that bought the index funds. Well, when I say index funds, ETFs. You just don't blame it on just one index fund. They bought ETFs, not really knowing, but their neighbors were buying them, and they can't make any money, putting their money into treasuries, so they bought them. And then when they get panicked, they don't even know what they owned. When I was a young broker, my next door neighbor would buy stocks, but he would know. I was in a relatively poor middle class neighborhood, but they would still know what stocks they had. So they wouldn't just throw everything away. Here they just go to the fund and say, "Okay, give me my money," and you have a machine that goes and sells the stock. So it's the same idea. The machine goes and sells your stock, and they have no idea whether it's good, bad, or different. And this is one of the problems that I think we have today. It's coming to fruition. And by the way, you still have it. I mean, my biggest position, by far, my biggest position is a short. I would call it a short on the CDS. On the CDS is something called the CMBX. And the CMBX, it gets a little complicated, but to just sort of try to.
But those are assets that back mortgages on office buildings and shopping malls.
Exactly. So what happened is it got happening all over again. There you have mortgage-backed securities that blew up. Here you got stuff like these CMBXs and other stuff too that I think are going to blow up. You have a bunch of mortgages. So the banks had back, 5, 6 years ago, 7 years ago, more than that. They went out, loaned money against a lot of shopping malls, office buildings, hotels, and retail, and they sold. They sold mortgages on them. They gave mortgages on them, and then when they did those mortgages, sliced and diced them, and put them in something called the CMBX, an index, CMBX. So I'm working on the CMBX 6, and it's incredible that you got these you have these mortgages. And so they sold bonds. I don't want to complicate it, but they sold bonds against these mortgages. Now you have CDS, something called CDS, which brought down us in 08. We got the same thing. You got the CDS now, collateral debt swaps. That's sort of an insurance policy. So it's almost a little bit of a gambling casino. And you got insurance policies on these bonds, the bonds that were sold. And they buy and sell them. Now you have credible institutions putting their customers, the customer comes into a bond fund. And then the bond fund says, well, we're fighting another bond fund. We're competing. We're going to get you better because and they say we take prudent risks. We take some prudent risk. Would they go out and sell insurance? They sell insurance on a lot of these bonds that now are in grave danger. A lot of the bonds that were done in 08 and 09, they're in grave danger. So they sell insurance, and I'm sort of simplifying it. Insurance, it's like selling insurance on somebody that's going to go to the electric chair in a couple of months. So you go in, and somebody comes to you and says, I got a great insurance policy for you, but he doesn't really explain it. Nobody quite understands what the insurance policy is. Well, the manager of that fund that's selling the insurance policy, he's just selling it, and he's making his fees or whatever. This guy now says, I'm giving you insurance policy, and geez, I'm going to give you an 8-9% return on it while you're waiting on this guy or something like that.
So, I mean, look, I'll simplify it even more. Basically, you are betting on further problems with shopping malls, perhaps exacerbated by what we're going through with the coronavirus and office buildings. Is that accurate?
Exactly. In this short I'm doing, I'm buying the insurance. We're selling the CDS. In other words, I'm short the CDS, which means I'm buying the insurance. And so that short of that CDS, not to complicate it too much, is selling today for 86 or 87. It's on the CVX 6, which is like on the triple B tranche. But it's ridiculous for anybody to sell that insurance to me. I mean, it's really analogous to the guy going to the electric chair and I'm buying insurance on his life and somebody's selling it. So you got these institutions today that are selling this insurance because they're getting a good return. So they put it in and they just show, hey, look, we're getting 8 or 9% for you. And they put that out every quarter and say, oh, aren't we great? And nobody quite understands that they're going to be facing already, they're already, I think, underwater on a lot of this stuff. So theoretically, there's people that are giving it, that they're getting to sell the insurance. Theoretically, they could lose all their money to make their 7% return. So they make their 7% return and they said, well, that's okay. What's wrong with that? But I don't think they understand. Now, in the little print, when they sell them the fund, I don't think they're doing anything illegal. The big mutual funds, and they're all credible. These are credible institutions doing it again. Putnam, Alliance Bernstein have sold, I think, $15-16 billion worth of this stuff, and maybe more, and there are many other ones doing it too, not just them. I mean, so this is the same kind of warning I was talking about before. You're going to have this blow up too, and nobody is even looking at it. And who's going to suffer? Again, you know who's going to suffer? The individuals, or maybe the wealth manager put the money in, are going to suffer just like they did in 08. I don't know if the government is going to bail them out. But and now, yeah, you're right. Right now, these shopping malls could not pay back or restructure their loans. So they're going to default. And I really believe almost definitely they're going to default. Anybody that would do this trade, nobody in their right mind, if they understood it, would do it, because you're looking at these shopping malls that could default. And now they also have a lot of office buildings in there. So look at office buildings today. So office buildings, and by the way, these malls are sort of, they're not the A malls, they're the B and C malls. And then they got office buildings all over that we are buying into the insurance on that they're selling. And these office buildings, for instance, are now they now have tenants. They say, well, we're okay. Look, we got all this lease payments, but a lot of the people that pay those lease payments, a lot of those companies are the ones that are going to suffer, that are suffering, because they shouldn't have had the money in the first place to rent that stuff, because they went out and borrowed this money at low rates. Now, some of them are okay. A lot of them are okay. But that's my point.
The more though that these things suffer, the more money you will make by holding the insurance that you do.
Yeah, well, I don't like to think of that.
I'm trying to simplify it. I'm trying to simplify it as much as I can for our viewers.
You say it right. It's a ridiculous trade. I'm only talking about it because, there were people, I think, like myself, that warned about the stuff in 08. Nobody listened. I hope somebody will listen, because we're really going down a toboggan slide with the CMBSs today. I think so you're looking at these companies today that are over-leveraged with high-yield bonds. You look at it all today, and we now keep pumping money out there and pumping money out there and pumping money out there, and there's a price to pay for that. I mean, the price to pay for it, that the people that can borrow that money, the people that go out and take the money, they're not bad people. They're no bad people. I don't think Putnam is necessarily bad. I doubt that Putnam and Alliance Bernstein, even on the top offices, even really understand what they're doing there. I think they just got people doing it because everybody makes bonuses. It's human nature.
Let me do this. Let me move on and talk about Oxy, because you made big news this week, and I mean in a big way too. You went from 2.5% in Oxy to 10%, and I'm wondering, right? I mean, you've been in the stock for a long time. How much of that was to try and capitalize on the drop in oil prices?
Well, when you're capitalizing on the drop of oil prices,
you bought more because you took advantage of the drop in oil prices to buy more stock?
Well, you took advantage of a lot of things there. It wasn't just the oil prices. It was just that the company is a terribly run company. The company is just terribly run. They had to cut the dividend. The oil prices, again, the match that ignited it. I think it's a very good company and very good, which is what I do with an awful board that really shouldn't be there. Yeah, you know something? I'll tell you this, Scott. In another culture, the people on the board would have the dignity to resign. Okay, but so one guy maybe was fired, the chairman, or maybe resigned. You still got the same damn board. They should have controlled their CEO. As much as you say Vicky Holland is at fault, they should have controlled it. Where the hell were they? She went out and bet the whole company on a transaction that made that at the price she was paying, she was betting the company. And you got the money from Buffett. I said one thing I've learned in life. I've said, maybe you heard it. I learned in life, you shouldn't give your money to a manager that thinks they can that can outsmart Buffett and outbid Chevron. And that's just what they tried to do. They ran into a wall. It was one of the dumbest trades I've ever seen. So now you got this company, and yet they're still there, and it's still going to be that's one of our problems in corporate governance today, and it's still going to be hard to get them the hell out
Well, what
of
do you
there.
do? So what do you do now, though? I mean, do you want the company to consider selling itself? Look, frankly, I've been wondering whether you would consider trying to take the company private with some other folks, just given the slide in the stock and where the valuation, the market cap has dipped down to as the stock has gotten slaughtered.
Hey, Scott, we know each other. I'm not going to talk about some of these ideas. They're all good ideas you're talking about, but I'm not going to discuss those on the TV. However, we do have a slate up there, and we're going to, try to get control of it at their meeting now. I don't think they've set a date yet. And we're going to try to get control of this company because I think it is a very good company, but I think what's going to happen in that industry, has to happen, I think, is consolidation, especially in the Permian. So what happened here was that, and I'm just being cynical perhaps, but this company knew that somebody wanted to buy them when that stock was $70. So, I mean, you can't believe the stock. I mean, you had a stock at 70 that's now 12. As bad as this market is, this is the poster boy for this market. I mean, this one, as bad as it's done, this is one of the worst actors ever. And at 70, I believe there were bids around for it because this company is a good company, should be consolidated, and to get away from those bids, they went and did this ridiculous deal, and the board permitted it because they had their own agenda, and we've gone and tried to get the information, and normally you should be able to get it in a proxy fight, but we've had trouble with the courts in Delaware. We're still there trying to get the emails and whatever to see if indeed that happened, and if that happened, then I really do think then it's really reprehensible.
Well, they did. They adopted a pill today. I'm sure you saw. They are going to give shareholders a chance to vote on it. What's your reaction?
Well, you're going to vote on it after the meeting, right? The pill is going to. In other words, they're going to vote on it after the meeting. If I want to buy stock, I got to wait through. Well, I could go to 15%. I got about 9.9 now. But if somebody wanted to go to 15%, they can't go over 50. So if somebody wanted to go out and buy 20% of this company at 25%, you couldn't do it. They stopped that.
Would you go up to 15?
Well, that's not the issue we're talking about. I'm just saying, you said, well, you can vote on it.
Yeah.
You can vote on the pill and put it out, but that's a little bit like the horse is left out of the barn, and then you kind of close the barn door. I mean, look, the company is just, when you look at it, it's a study in what shouldn't be done in corporate America, and it makes a travesty of corporate governance.
So let me ask you then about another situation you're involved in. You have a stake in both Xerox and HP, and today, right before we came on the air, Xerox said it was pulling its efforts around the deal because of what's going on in the coronavirus.
Well, okay, but hold on. I have to be careful here. I got to be careful. That's why I don't like coming on these shows too often. I only do it once in a while because you got to remember that I'm recused from that board because I own HP and I own Xerox, so right. I'm recused from these deliberations. However, I don't think you're reading that right, Scott. They're just saying we're not pulling out of anything.
No, I'm not pulling out of the deal, and I don't mean to suggest that they are. They're just to do it.
With the coronavirus and all that going on, they don't want to go on a road show now to go visiting people all over the country to talk about this deal when everybody understands the deal anyway. It would be a great deal.
Shouldn't HP just wind up? Why shouldn't HP just take the money and run at this point?
Why don't you call them and ask them? It's a great question. I don't know why. Because like anybody else, like any other board, like these guys on the board, in many cases, think it's their company, and they think they look. If you're a board member, in many respects, you have a real good deal. You sit there, you go to 4 meetings, you get paid $100 grand sometimes for a meeting. You talk. You ever go to these board meetings? It's sort of a.
I haven't had the privilege.
Well, I'd like to take you to one day. You won't want to go back to many of them. I mean, they joke. I mean, it's not they're bad people. They're not bad people. It's what, hey, if you could get away with it, you do it. They're on the board. They let all this happen. Here they have the company, and what has it done for the last 20 years? And they keep talking about this and that and this. And if they get a bid for this company, they should take it seriously, and they should say, okay, let the shareholders decide, and maybe they will.
Well, there was some suggestion. There was a report I saw the other day that said you floated the idea of buying HP yourself if this thing didn't happen. Is that true? And would you still do that?
Yeah, look, I think it's taken out of context, and I can't even remember the conversation, Scott. But I mean, I didn't make any bid for it or anything like that. I mean, but that's not even the issue here. I mean, the issue is the synergies here are tremendous, and the company HP admits this tremendous, and admits it. And I think the thing I have said publicly is, if it goes together, as far as I'm concerned, as a shareholder, I would want John Visentin, who's running Xerox, to run the company, because Visentin, I think, has shown already his ability at Xerox and has cut the heck out of costs there and has done a great job there. Not just costs, but has done many great things. HP hasn't done any great thing for the last 5, 6 years. So I said, in any way, put the companies together. As far as I'm concerned, I own stock in both of them, but I want Visentin to run it. That's all I care about.
Let me ask you lastly, because I'm running out of time, and something that our Contessa Brewer is very interested in, and it's this casino situation. I know she's interested in it because she wanted me to ask you about it, and I'm going to do that. El Dorado and Caesars, is that deal still going to happen? I mean, there's a lot of considerations now. Debt levels, revenues falling. Is it going to happen?
Well, look, I'm on the board, have representation on the board of Caesars, and so I can't talk too much. But I think it's a great deal. I think it should happen. It's tremendous synergies there too, just as they are in HP. So I really think, I believe it will happen. But I can't, I'm not going any further than that. And of course, I'm not on the board of El Dorado.
Right.
But Tom Reeg is a great manager. And I have, I believe that he can make all those synergies happen.
But let me ask you this then. Let me ask you this though. If Vegas takes a significant hit because of the virus, which is likely, I mean, one has to assume that they will. As I said, a deal that's heavily financed. Is there an issue in your mind with being able to service debt, a large amount of debt, at a time when revenues are declining because of the situation we're dealing with?
Yeah, and see, everything's unique, and I've said there's too much debt in the country. But in this case, when you look at the synergies of these two companies, and this is public and people can look at it, you look at the great synergies can happen. And, Caesars was not a well-managed company by any means. There's tremendous amount of money that could be saved. I think the debt will be serviced, and there's plenty of room in it. So that's my opinion. Just look at the numbers. Not speaking as a board member, but speaking as anybody else that can look at the numbers.
So leave me with one last thought before I let you go. So I get that you're maybe a little bit less bearish than you were because the stock market has come down by a tremendous amount. It's been a hell of a week. I mean, we're all sort of feeling the pain of where we are and where we may go from here. Leave us with a last thought of really how much more selling do you think needs to be done, and how much more advantageous do you feel like you want to be in the weeks ahead?
When you see selling that you want to be, what do you mean by advantageous? I don't understand.
Well, if the market goes down more, are you going to be even less and less bearish, willing to buy even more and more stocks?
Yeah, let me say it a different way. I still think my hedges are good. I've been hedged for 3 years, so I'm not getting hurt nearly as much as a lot of other people. But my point is that there are stocks here that I look at as companies, and these companies are good companies. Occidental is a good example. Hewlett Packard. They're good companies, they're good value. There's good assets. You know, the oil is still in the ground, and the country's going to need oil, even though you got that war going on with Russia and Saudi Arabia. So you're going to need these things. So there are companies that should be bought. On the other hand, they're way overpriced. There are many very overpriced companies and very high multiples with too much debt on them. And those should be sold. I mean, I think they're coming to a realistic price. A lot of the companies in the S&P with these dream companies, sure, some of them are going to hit, some are going to come up with their dreams, but with those companies, you're paying still very high multiples in my mind for dreams. So you got a tale of two cities. And on the other hand, there are some of these crazy derivatives. I think it was Buffett that once said these derivatives are weapons of mass destruction. And the one I explained to you, and you can find these, where the risk-reward are crazy in those. I mean, so you still have a lot of problems in this country, and I think you can't get just way out of these things by just printing and printing and printing money. Mm-hmm. Because it's just you print and print and print that money, and that money is in many cases run by the wrong people, and you got too much debt on many companies. Now then you say, well, what about Caesars? But I don't think that's true of the Caesars because of the great synergies and the good management.
Okay.
So there's different. You can't answer it with one answer.
I understand. Carl, we'll do it again. I appreciate you coming back on. It's been a while. It's good to hear your voice. Be well. We'll talk to you soon.
Okay. Good talking to you, Scott.
All right, that's Carl Icahn joining us. Let's go to David Faber now as breaking news regarding AT&T. David?
Yeah, Scott, of course, we know so many companies that are changing the way their workers work. And you can add AT&T to the list. Why is that notable? Well, they have 245,000 employees around the globe. And about an hour or so ago, a little more than that perhaps, AT&T's chairman and CEO Randall Stephenson told those employees in an internal memo that if they can, they should get their job done from home. Now, that obviously does not necessarily apply to some of the members of AT&T, the employees there who serve directly and interact directly with customers or have to be out in the field and do things like that. But it is notable because you're talking, again, about an enormous workforce, both here and globally, 245,000 people around the world. And Mr. Stephenson, the company's leader, is saying, if you can, work from home, and they are also making and taking contingencies as well to help protect people who are not necessarily able to work from home. He said in an internal memo, I'll leave you with this. We cannot control what's already happened, but we do control how we respond from here. As you well know, Scott, of course, so many employers around the nation have done similar things with their employees. A lot of people going to be working from home. Back to you.
Fabes, quick. I mean, I only got 2 minutes to go. You have a reaction to anything that Icahn said? You follow his investments closely. You follow sort of the deal market closer than anybody, and certainly Xerox HP.
Yeah. I do. I think we know what he wants at Xerox HP. We know he's going to continue. There's so many things that he's involved with right now. It is fascinating. I think, though, what you spent a lot of time on, of course, his purchase or essentially shorting the credit of and shorting the insurance that he was buying on the mall operators was fascinating. Apparently, as we heard, an enormously profitable trade for him. Very curious who's on the other side of that as well, Scott, but always interesting to talk to Carl. He sees stuff that's cheap. You and I both know that, but interesting, he didn't necessarily see that it's a market bottom.
Yeah, less hedged than he's been. David, thanks so much.
Sure thing.
It's fortuitous for us to have you at this moment as well. It's David Faber. Let's go to Phil LeBeau, who has a news alert for us on Delta.
Scott, I know we're running up against the top of the hour. 3 bullet points from a memo that Ed Bastian, CEO of Delta, has just sent out. We're taking a look at it now. 1, the reducing capacity over the next 4 months by 40%. On Tuesday at an analyst conference, they said it would be a 15% reduction, so that is a dramatic increase there. The other thing, Ed Bastian says that over the next 4 weeks, they are seeing negative net bookings. Think about that. They're seeing more money going out than money coming in over the next 4 weeks. And as a result, Ed Bastian saying he will forego his entire salary this year. 3 bullet points from Delta as they are trying to react to the growing problem of people not booking flights because of the concern about coronavirus. Scott, back to you.
Phil, appreciate that very much. New investor Joe Terranova says what?
Howard Marks, Warren Buffett. It's going to feel lousy for a while, but I think it'll be okay.
All right, Josh Brown, leave us with a thought, please.
I agree. Expect bad headlines, but watch the reaction of the markets.
I think when we come out of this, the wind is going to be at our backs. We're going to have low oil prices, low interest rates. We're going to be in really good shape.
All right. For the meantime, we'll see how this day finishes up. Right now, the Dow is good for about 600. Have a great weekend. At least try to. The exchange begins now.
Thank you, Scott. Hi, everybody, and welcome to The Exchange on this Friday. I'm Kelly Evans, and the market is desperately trying to hold on to its gains today following the worst single-day drop for the Dow since 1987. We're up 566 right now, but we were up over 1,300 points at the highs. We've been losing some steam into afternoon trading. We're still on pace for the worst week since 2008 here. And the capstone to the week will be the president's 3 p.m. press conference to reportedly declare a national emergency. Bob Bassani is on the floor of the New York Stock Exchange with more on today's action, Bob. Again, as I said, as we try to hang on to these gains.
That's right. And we were drifting lower throughout the morning after starting big. 1150 was the bottom. And that's when we got word that the president might declare a national emergency. So if you put up the S&P, you'll see essentially we turned around and started going back up right about the time we heard word about that. So this is some form of fiscal stimulus, if in fact that is what the president is doing. S&P's down about 15% for the week. Boy, what a number. And yesterday, for the first time, we started seeing some real differentiation in some of these sectors. Generally, everybody's been down for the week dramatically, but yesterday it started to change a little bit. We saw cyclical stocks like Dow, Boeing, Exxon, all down more than the rest of the market, and that generally is the situation for the week. If you take a look at more consumer-oriented names, they're all down. Did better than the S&P 500. So I'm talking about Walmart or Merck or Johnson & Johnson. See, only down 10% here. And even, this is interesting, what we used to call high-growth fintech names like Visa and Apple also did better. Still down, but did better. So we started to see a little change. This happened just yesterday. We'll see what the president has to say at 3 o'clock. Kelly?
Yep, looking forward to it. Bob, thanks very much, Bob Bassani. And after the Fed's extraordinary move to inject more than $1 trillion into the markets, Treasury Secretary Steven Mnuchin telling CNBC earlier today that the fiscal stimulus talks are going well. Let's get out to our Steve Leisman for more. Steve, as we wait every dribble and drabble we can about how the process is going between him and Pelosi and so much more.
Yeah, $1 trillion dribbles and drabbles. That's where we're at, Kelly, right now. Let me say the New York Fed today did speed up some action. We talked yesterday about them coming in doing $60 billion of purchases. That was supposed to be over the course of a month. Well, they did half of it this morning, came in with $37 billion of purchases across the Treasury spectrum, different types of maturities and instruments. Now, we're hearing from several sources that it had some limited effect, but not as much as you would expect what the Fed did yesterday, and they are looking for the Fed to do more. As Kelly said, we talked to the Treasury Secretary this morning, and he says they're talking to the Fed quite a bit.
I'm in constant conversations with Jay Powell. The Treasury and the Fed have many authorities. We don't have the same authorities we had before Dodd-Frank and the financial crisis, but we do have authorities. We will be looking at using those. The Fed yesterday injected $1.5 trillion in an unprecedented move. They announced $60 billion of bond purchases. So we're looking at a whole range of alternatives.
So, as you might imagine, we've been talking to senior executives in the financial industry, and here's some of the things that they think the Federal Reserve might do. The first is obvious, cut rates to zero. That's a lot of big expectation on the street. They're looking for more quantitative easing. That is the Federal Reserve to go in and purchase more assets. That could help unclog some of the illiquidity out there. Possible regulatory relief for banks so that they can take those Dodd-Frank new liquidity ratios, bring them down so that banks can be counter-cyclical rather than pro-cyclical, making things worse by keeping things so tight. Finally, there's even a comment out there the Fed should buy commercial paper. In any event, PIMCO writing, we think it's likely the Fed cuts the Fed funds policy rate to zero and confirms they will do whatever it takes to support markets. And speaking of zero, Kelly, I will give you right now the most up-to-date percentages. There is a 49% chance, or 49.5% chance, if you must, that the Fed goes down by 100 basis points at the meeting next week, and a 50.5% chance that it goes 125 basis points next Wednesday.
So there's a 50-50 chance that the Fed goes negative next Wednesday, even though nothing in their commentary has hinted they might do that.
Sorry, that's not negative. That would be, it would go, it's now between 100 and 125. So let me talk in terms of ranges, because that's actually the way it's expressed.
I know, it's
tricky. I can see how I was confusing there. So it's 100 basis points would bring it down to 25 to 50. And 0 to 0.25, there's a 52% chance right now.
Wow.
So that would be the full call it 25 basis point cuts.
I don't know if this distinction even matters, Steve. I mean, they're effectively going to zero, and the whole discussion now is going to turn to what comes next.
I think that's right. And I will say that my best guess is the Fed's going to do what it can to avoid negative. I think we gave sort of short shrift to what Christine Lagarde didn't do yet the other day, which is she didn't go further negative. It makes me wonder if the ECB feels like it's hit a limit on going negative. I know the Fed is not that interested in that particular policy choice.
Yeah, that's definitely the vibe we've gotten so far. Steve, thank you. Steve Leisman with the latest for us.
Pleasure.
For more on what the policy response here should look like, I'm joined by Craig Callahan. He's president of Icon Advisors. Fred Mishkin is former Fed governor and currently a professor at Columbia University. And Quincy Crosby is here on set with me. She's chief market strategist at Prudential Financial. Fred, I'm going to come straight to you because we were just talking about what the Fed might do. Do you think they would never go negative?
It's very unlikely. The problem is not that they wouldn't like interest rate to be lower, but they don't feel that going negative is actually going to be beneficial. And I think that Steve Leisman put it exactly right. That the reason that the ECB didn't lower rates further is because it's not clear that that would be beneficial at all. So the issue with this one, it tells us that monetary policy is limited in its ability to deal with this kind of shock.
How would you describe this kind of shock relative to the 08-09 one that you were there for? And, you know, there was a great line by Dave Zervos, the economist today. He said, this is about solvency, not liquidity. You know, these things all become intertwined if it goes on far enough. My point is, how different could the response be in order to address solvency, business operation issues, as opposed to the liquidity kind of issues that were really at a climax in 08-09?
So the Fed really can't deal with pure solvency issues. What it can do is make sure that the financial system actually functions well. And that's really what
Welcome back to the exchange. Trading action has been fast and furious this week. The week that was on pace to be the worst since the crash in October of 1987, depending on how we close out today. So let's take stock of how we got here. This is Monday. Stocks plunged to start the week. It was coronavirus fears. And remember, the shocking oil price war between Russia and Saudi Arabia. The Dow falling 2,000 points and oil plunged nearly 25%. You can see here we really just kind of tanked into the close as well. It was the worst day for stocks since 2008. Then came turnaround Tuesday. There. See, I'm getting the hang of it, guys. There, turnaround Tuesday. I'm getting the hang of it as we go on here. It's a better mood momentarily. We rallied 950 points in the morning. Although at 11:25 a.m., the mood changed after congressional members said an economic plan is, quote, not there right now. And the CDC said this outbreak is beyond containment. There we go. Let's clear it up. So this is Turnaround Tuesday. We started strong. We lost our gains a little bit in the middle of the session. Then the president said he would visit Congress the following day and consider a payroll tax cut. And then stocks took off on that news into the close. It ended up being the best day since December of 2018. Different story. Big change of mood on Wednesday. The WHO declared the coronavirus officially a pandemic, and D.C. failed to announce any concrete plan for stimulus. The Dow fell 14,064 points. That was its second biggest points loss ever. 1,400 points, I should say. But let's flip over to Thursday then. Another historic day, and not in a good way, with the Dow and the S&P posting their single worst percentage drop since 1987. The president failing to impress the market in his primetime address to the nation the night before. The Fed's announcement that it would inject more than $1 trillion into the system didn't help, and we officially closed in a bear market yesterday, ending an 11-year bull run. So here we are today, up more than 800 points, but off the highs of the session and up about 900 now, in fact. As I said, this will determine whether it is the worst week for stocks since 1987. And as companies put contingency plans in place for coronavirus, the New York Stock Exchange, too, has a backup plan. What would happen if the trading floor had to be shut down? We go to Bob Bassani for that. Bob?
And the important thing here, Kelly, the NYSE is now allowing most personnel to work from home. Now, traders here on the floor, they're right here behind me. And for the most part, they're not NYSE employees. So yesterday, I asked NYSE President Stacey Cunningham what would happen to the floor in the event someone tested positive for coronavirus. Let's listen in.
If there is an outbreak, we can clean the floor and reopen pretty quickly as well. So that's something we're not planning to close the floor at this time. But as you mentioned, we could, and we could trade fully electronically.
Now, the NYSE has a business continuity plan in place for decades in case the floor needs to close for a flood, a snowstorm, or any other disaster. But this plan would allow the NYSE to trade electronically without the floor if it needs to. The market makers and the floor brokers that are here can continue to participate in that electronic trading, though there may be some limitations around the closing auctions. The NYSE has closed many times over the years, notably for 4 months of the outbreak of World War I. That was 1914, the death of JFK in 1963, after the 9/11 attacks, and after Hurricane Sandy in 2012. In the situation now, there is the possibility of closing the floor but keeping the markets open electronically, and that's different. Traders tell me that many teams are splitting up now. Behind me, for example, some working from separate offices in order to avoid having an entire firm self-quarantine, a model that's being adopted by many companies. And Kelly, you heard from Secretary Mnuchin this morning, they do not want to close the markets. In the event they have to close the floor, maybe, but nobody wants to close the stock market, and that's coming right from the top in the White House. Back to you.
All right, Bob. Thank you very much, Bob Bassani. Now let's get to Sue Herrera for a CNBC News Update. Hi, Sue.
Hello, Kelly. Hello, everybody. Here's what's happening at this hour. The Los Angeles and the San Diego school districts are closing starting Monday because of the coronavirus. That move affects 750,000 students. It is the latest in a series of school closings worldwide. Canada is advising against all non-essential travel outside of that country. Overseas flights returning to Canada will be limited to certain airports, and travelers will be asked to consider self-isolating themselves. Germany's finance minister is condemning President Trump's European travel ban, calling the move, quote, grotesque. The minister is calling for solidarity between countries in the fight against the outbreak. And the Olympic torch relay in Greece has been halted after just one day. Organizers called off the relay after it attracted unusually large crowds. The handover of the flame to Tokyo Olympic officials will go on as planned next week. Lots of moving parts today. That's the news update this hour. Kelly, back to you.
Yep, and all week. Sue, thanks very much. Sue Herrera, coming up, the president is expected to declare a state of emergency this afternoon at 3 p.m. This as congressional leaders work around the clock to hash out any potential stimulus. We'll have the very latest. Plus, the hot spring housing season is facing some challenges from the coronavirus. We've got the numbers on that. The Exchange is back in
Can you win me over? Just give me a sign. I know I've been watching you in the glove for some time. I hope that you can be mine. 'Cause you're beautiful to me. And we will be shining bright. Yeah, you will see. And every time you say my name, I start to act insane. Just to impress you, girl. It's a short surround of the question. I need you to make a lasting impression. You could like the way that you move. Whoa.
For the past few months now, the nation's top military, intelligence, and law enforcement officials have been warning Congress and the country about a coming cyber attack.
Another weapon added to the arsenal in cyber warfare.
We have entered into a new phase of conflict in which we use a cyber weapon to create physical destruction.
A battle is waging across the internet.
China's military successfully hacked into Pentagon computers.
Electric infrastructure will be hacked and taken down.
Millions and millions of people were caught by surprise when the electrical grid suddenly crashed.
5 national cyber police forces are involved in this attack.
Chinese sleeper viruses on the electric grid.
Nuclear power plants will be hacked.
Hospitals are closed.
They completely knocked out the substation.
Major disruptions to the water supply.
Police in riot gear.
The report links China.
The Chinese are doing this. The Chinese government is doing this.
The U.S. considers it an act of war.
Well, the messages don't mess with us.
The biggest threat to cybersecurity right now is the United States government.
So it's going to be interesting. If we break down again, time where everyone has been calling for bipartisanship, that becomes at least potentially problematic for markets.
You know, it's interesting, and time permitting, later this hour, we're going to be hearing anecdotal evidence of local municipalities, local businesses, what they're able to do to try and mitigate the impact of all of this, Michael. And you know, so at the grassroots level, there is work going on right now.
And it's really encouraging, and I think it's very encouraging to see the way communities are coming together, and school systems are closing, and people are very concerned about those who are most vulnerable. So there's a lot of evidence that things are going to work as best as they can work to keep communities moving forward, which also keeps the economy moving forward, which is, I think, going to be reassuring to Wall Street. This has to happen, and the more uncertainty and bipartisanship, as Ron said, isn't going to be helpful, and markets won't take that well.
And Ron, you know, we all remember very well those votes in 08 when we were trying to
The provision in there for unemployment for those people who've been displaced.
I also want to bring in Stephanie Link, CNBC contributor. Both with us for the full first hour of the show with markets at the moment 822 points. Mike, break down for us the action we've seen today. A fantastic open, a significant bounce back, slip from those levels, and of course a lot resting on what we're going to hear from the president.
Yeah, it's almost one of those days where if there was not a significant bounce, it would have been suspicious, because down 10% just about yesterday. When you've had a day that was down 6% or more in the S&P, the average bounce the next day is almost 3%. So essentially, that was pretty much pro forma. Middle of the day, I think there was a little bit of uncertainty as to whether there were real buying or just short covering. And then, of course, the announcement of a 3 p.m. presidential news conference, just a little bit of static as to what that might mean. But ultimately, I don't think necessarily that's the driver of this last little burst higher. I do think it was just that we're just so brutally oversold that you almost had to lift unless something else kind of blew loose in the financial markets.
We were seeing a lot of head scratching, Stephanie, after the president's last news conference where he failed to deliver a major policy initiative to tackle the coronavirus, to detail any specific steps. Can he do anything right now to change how investors are feeling about the immediate future?
Well, I actually think over the last 24 hours, the moves by the Fed in terms of monetary policy changes and improvements, and also the actions by the White House and Congress to do something on the fiscal side. I think the sense of urgency is definitely more there now than it has been, and I think that's actually encouraging. But I think the volatility is here to stay for a while, and that's because as you get more tests out there, you're going to have more cases out there, and that's going to be alarming for people. So I think we have to get past the next 2 weeks, which is when I think you're going to see kind of the peak numbers come out, and then maybe the dust can settle a little bit. We can kind of incorporate what all of this means to the economy as well as to earnings for stocks and investing.
A reminder that we are awaiting a presidential address from the Rose Garden outside of the White House. You can see that live picture there. We're awaiting the president. As we stand, the S&P 500 is up 4% with 55 minutes or so left of the session. A reminder, though, that it is down 13% in what has been a torrid week for equities. Eamon, we saw a large amount of action from the Federal Reserve over the course of the last couple of days, and everyone is now waiting to see if the government and Congress are going to back that up. But what did you make of the way that we saw Speaker Pelosi come out an hour ago ahead of the president? Do you get the sense that the two sides, Republicans and Democrats, are coming together and unified yet, or are we still some way from that?
I think we're still some way from that, or we were at 2 p.m. This is a very fast-moving situation. But, you know, if there was bipartisan unity here, you'd see the Speaker of the House and the President of the United States together on a stage somewhere announcing a joint deal. We did not see that. We saw the Speaker coming out an hour before the President was scheduled to speak. She knew the time he was scheduled to speak at the time she scheduled her remarks for an hour before him and said she was moving forward. So this is not the two sides on the same page. They may end up there. This is clearly an ongoing negotiation as you talk about those calls between Mnuchin and Pelosi right after her remarks. This is a rolling negotiation here. We'll see where it ends up. But in terms of the Fed, I mean, fascinating to see the president's tweets today about the Fed calling for them to take more action, right? The president does not think that $1.5 trillion yesterday was enough. The president wants massive QE, much lower rates, and he wants it now. He thinks the Fed is asleep at the switch, and he's not afraid to say so publicly. That's been a consistent theme of the president's, and $1.5 trillion didn't change that.
You know, what's interesting is that we had the former Treasury Secretary, Jack Lew, on yesterday, who pointed out that the nation's companies have already had a massive tax break, and they should have, he said, cash on hand to deal with this kind of crisis. Mike, when you're looking at the liquidity issue and the Fed trying to tackle that, that's not the thing that is going to reassure Americans that it's okay to go out and spend money if they need a new washing machine or if they need a new car or even going to the movies or restaurants.
Those are, they're separate but interrelated issues. I mean, the financial market stress that came from markets trying to adjust to the sudden stop in the economy and the virus threat created this liquidity issues in the air pockets that the Fed is trying to lubricate here with their $1.5 trillion in liquidity. I do think, though, it's correct that it's not really addressing the issue of people missing paychecks and people staying home. And who knows what it's going to mean in terms of a prolonged stall for the economy. We simply have no endpoint on it.
Mike, just to go back to what's happening in the markets, not just today, but this week, we've had quite an odd situation where we've seen yields rise over the course of the week, i.e. bonds prices fall alongside equity prices falling, also alongside gold prices falling for the week as a whole, some 9% this week. Well, what's gone on this week compared to the prior couple of weeks of declines for equity markets?
The relationship broke down, especially yesterday, much of the week, but especially yesterday, when yesterday was essentially sell everything and it was a rush to cash. It was big leveraged, professional investors, it was individual investors. That's often kind of a give up moment in markets where it just doesn't really matter what it is. People were selling longer term treasuries to buy treasury bills at the very short end. So that's obviously more of a fear and panic indicator. I do think today it's worth noting that treasury yields are up and stocks are up, which is a little bit of a restoration of that former relationship. But of course, this has been a very staticky market. We can't be sure that's here to stay.
We are, of course, awaiting a live address from the president any moment now. But in recent weeks and months, the president and his advisors and cabinet secretaries have not been shy about telling the American public to buy stocks during the coronavirus-led meltdown in the market. President Trump just yesterday saying, quote, "It's going to all bounce back," but the White House's investment advice has not been particularly well timed. On February 24, Trump tweeted, quote, "Stock market starting to look very good to me." A day later, Larry Kudlow said, quote, "I would suggest very seriously taking a look at the market. That is a lot cheaper than it was a week or two ago." A few days later, Eric Trump tweeted, "In my opinion, it's a great time to buy stocks. I would be all in. Let's see if I'm right." He's since deleted that tweet. Stocks down about 20% since then. And then this morning, Treasury Secretary Steven Mnuchin called it a great investment opportunity.
I look back at people who bought stocks after the crash in 1987, people who bought stocks after the financial crisis. For long-term investors, this will be a great investment opportunity.
That, of course, on Squawk on the Street this morning. Mike, the thing I come back to on this, even if today's call by the Treasury Secretary turns out to be right, investors and market participants, many of whom I've been speaking to over the last couple of days, they don't want to hear policymakers address that. They want to get confidence that policymakers are sorting out the fundamental root causes of the problems.
Without a doubt. And it's also a good illustration of why it's always been hazardous for any administration to try and comment on something that's inherently unpredictable like the stock market. Now, the Treasury Secretary today did say for longer term investors, it does make sense, and you have really not gone wrong through history. Very often buying after the market has gone down 25%, if in fact you have a long-term holding period. So that's a little bit less of a risky proposition, but yes, trying to time the market rhetorically is impossible.
But let's move on the advice. Stephanie, what do you say to that this is a good long-term investment to get in now?
Yeah, I mean, it's impossible to time. And as you guys know, I have been actually buying small over the last 3 weeks because I don't know where the bottom is going to be. My strategy has been to focus on upgrading my portfolio, getting blue chip companies that are truly on sale, down 20, 30, 40%. I want to have companies that have good market share, good leadership, strong balance sheets, and looking at dividends. This is a big part of my strategy. When Cisco yields 4.2%, and I know that that dividend is safe, I will buy that. I will buy it all day long. I bought Blackstone, yielding 6%. The stock's down 25% in the last several weeks. And high-quality company, great management team. And by the way, they're going to benefit because they're probably going to be able to get some stuff on the cheap. The second way I'm investing is themes. One of my favorite themes is animal health. You're going to see pet spending grow about 5% per year, and the way you play that is Zoetis, which is only down about 9% from its high, so it's still not super cheap, but I like that company. I missed it a couple of years ago, so I'm slowly buying that one. I like Chewy as well for that same theme. And then lastly, I'm looking at what companies benefit from lower interest rates, and I look at Home Depot, and I see that 3% yield. And I'm buying that one as well.
his remarks as soon as we see the president.
Let's have a look. At the markets, we are up 4% on the Dow and the S&P and the Nasdaq. As you can see, Russell lagging behind, up 3%.
The hotspot right now, and talent or through luck, call it whatever you want, but through a very collective action and shared sacrifice, national determination, we will overcome the threat of the virus. I also announced Wednesday night, following the advice of our medical professionals who are doing a tremendous job, and we appreciate it very much, that we're suspending the entry of foreign nationals who have been to Europe in the last 14 days from entering the United States. Citizens, permanent residents, and our families, any of the families returning from Europe will be subject to extra screening as well as self-isolation for a period of 14 days. As the World Health Organization confirmed today, many of the things that what we said were 100% correct, including our designation before them of Europe. Like our earlier very aggressive actions with China, this measure will save countless lives. I appreciate a number of the folks behind me, number of the people behind me said that that saved a lot of lives, that early designation. But it is only the beginning of what we're really doing, and now we're in a different phase. We had some very old and obsolete rules that we had to live with. It worked under certain circumstances, but not under mass circumstances. They were there for a long time. They were in place for a long time, and we're breaking them down now. And they're very usable for certain instances, but not for this. To unleash the full power of the federal government in this effort today, I am officially declaring a national emergency. Two very big words. The action I am taking will open up access to up to $50 billion of very important and a large amount of money for states and territories and localities in our shared fight against this disease. In furtherance of the order, I'm urging every state to set up emergency operation centers effective immediately. You're going to be hearing from some of the largest companies and greatest retailers and medical companies in the world. They're standing right behind me and inside of me. I'm also asking every hospital in this country to activate its emergency preparedness plan so that they can meet the needs of Americans everywhere. The hospitals are very engaged. New York and various other places are also very engaged. I just spoke with Governor Cuomo. We had a very good conversation, and we're working very strongly with many states, including New York. The emergency orders I'm issuing today will also confer broad new authority to the Secretary of Health and Human Services. The Secretary of HHS will be able to immediately waive provisions of applicable laws and regulations to give doctors, all hospitals, and healthcare providers maximum flexibility to respond to the virus and care for patients. This includes the following critical authorities: the ability to waive laws to enable telehealth, a fairly new and incredible thing that's happened in the not so distant past. I tell you, what they've done with telehealth is incredible. It gives remote doctors visits and hospital check-ins, the power to waive certain federal license requirements so that doctors from other states can provide services in states with the greatest need. Number two, the ability to waive requirements that critical access hospitals limit the number of beds to 25 and the length of stay to 96 hours. The ability to waive the requirements of a 3-day hospital stay prior to admission to a nursing home, big thing. The authority to waive the rules to hinder hospitals' ability to bring additional physicians on board or obtain needed office space. They can do as they want. They can do what they have to do. They know what they have to do. Now they don't have any problem getting it done. The authority to waive rules that severely restrict where hospitals can care for patients within the hospital itself, ensuring that the emergency capacity can be quickly established. We'll remove or eliminate every obstacle necessary to deliver our people the care that they need and that they're entitled to. No resource will be spared, nothing whatsoever. 10 days ago, I brought together the CEOs of commercial labs at the White House and directed them to immediately begin working on a solution to dramatically increase the availability of tests. Other countries have called us and worked with us. And they're doing similar things or will be doing similar things. As a result of that action today, we're announcing a new partnership with private sector to vastly increase and accelerate our capacity to test for the coronavirus. We want to make sure that those who need a test can get a test very safely, quickly, and conveniently, but we don't want people to take a test if we feel that they shouldn't be doing it. And we don't want everyone running out and taking only if you have certain symptoms. Using federal emergency authorities, the FDA approved a new test for the virus. We did this within hours after receiving the application from Roche, a process that would normally take weeks. We therefore expect up to 500,000 additional tests will be available early next week. We'll be announcing locations probably on Sunday night. I want to thank Roche, great company, for their incredible work. I'd also like to thank Thermo Fisher. The FDA's goal is to hopefully authorize the application within 24 hours. It'll go very quickly. It's going very quickly, which will bring additionally 1.4 million tests on board next week and 5 million within a month. I doubt we'll need anywhere near that. At the same time, we've been in discussions with pharmacies and retailers to make drive-through tests available in the critical locations identified by public health professionals. The goal is for individuals to be able to drive up and be swabbed without having to leave your car. I want to thank Google. Google is helping to develop a website. It's going to be very quickly done, unlike websites of the past, to determine whether a test is warranted and to facilitate testing at a nearby convenient location. We have many, many locations behind us, by the way. We cover this country and large parts of the world, by the way. We're not going to be talking about the world right now, but we cover very, very strongly our country, stores in virtually every location. Google has 1,700 engineers working on this right now. They've made tremendous progress. Our overriding goal is to stop the spread of the virus and to help all Americans who have been impacted by this. Again, we don't want everybody taking this test. It's totally unnecessary. And this will pass. This will pass through, and we're going to be even stronger for it. We've learned a lot. Tremendous amount has been learned. I want to thank Deborah Birx, and I want to ask her maybe to come up and say a few words as to what's happening. Dr. Birx is a highly respected person I've gotten to know very well over the last 6 days. And what we've done is rebuilt something that was very old-fashioned, somewhat obsolete, certainly obsolete when it comes to the kind of numbers that we're talking about. Dr. Birx, please. Thank you, Deborah.
Thank you, Mr. President. It's a pleasure to be here with all of you. I think you know at the beginning of this epidemic, HHS through CDC proactively developed an assay built on the existing flu surveillance system. That surveillance system was then converted to diagnostic system. But last Tuesday, seeing the spread of the virus around the globe, the President realized that our current approach to testing was inadequate to meet the needs of the American public. He asked for an entire overhaul of the testing approach. He immediately called the private sector laboratories to the White House, as noted, and charged them with developing a high-throughput quality platform that can meet the needs of the American public. We are grateful to LabCorp and Quest for taking up the charge immediately after the meeting, and within 72 hours, bringing additional testing access, particularly to the outbreak areas of Washington State and California, and now across the country. We are also very grateful to the universities and large hospital systems that took up the charge to develop their own quality tests, made available by new FDA guidance. This has resulted in expanded testing across New York, California, Washington, Colorado, and you see sometimes those drive-through options that have been made available through these high-throughput options. Following the meeting last week, major commercial laboratory equipment and diagnostic companies took immediate action to adopt and develop new testing systems. Last night, the initial company, Roche, received FDA approval, moving from request to development to approval in record time. This innovative approach centered fully on unleashing the power of the private sector, focusing on providing convenient testing to hundreds of thousands of Americans within short turnaround times. In less than 2 weeks together, we have developed a solution that we believe will meet the future testing needs of Americans. I understand how difficult this has been. I was part of the HIV/AIDS response in the 80s. We knew from first finding cases in 1981, it took us to almost 1985 to have a test. It took us another 11 years to have effective therapy. It is because of the lessons learned from that we were able to mobilize and bring those individuals that were key to the HIV response to this response. I understand that a lot of this behind-the-scenes action over the last couple of weeks was invisible to the press and the American people. But this intense effort has not only resulted in innovative solutions, but an automated, high-throughput system bringing the availability of these quality coronavirus testing to the American people at unprecedented speed. Finally, I want you to know in South Korea, they did have a large number of tests available over the last several weeks. Their positivity rate is between 3% and 4%. With LabCorp and Quest expanded testing, their positivity rate is between 1% and 2%. So we want to also announce this new approach to testing, which will start in the screening website up here, facilitated by Google, where clients and patients and people of interest can go, fill out a screening questionnaire, move down for symptoms or risk factors, yes. They would move down this and be told where the drive-through options would be for them to receive this test. The labs will then move to the high-throughput automated machines to be able to provide results in 24 to 36 hours. That is the intent of this approach. We have seen it work just in our own United States, and we want to bring this across the continent. Thank you very much.
Thank you very much. I'd like to maybe have Tony, do you want to come up? You've become I think everybody out here knows you pretty well, but Tony has been doing a tremendous job working long, long hours, and you've seen a lot happen, but
the federal government will have as many constraints as possible removed for them to do everything they possibly can so that we can implement the things that we've been talking about, the containment, the mitigation, so that, as I've said many times, that curve that I refer to that goes up, we don't want to have that curve. We want to suppress it down to that small mound. And I think what we've done today is something that is going to be a very important element in having us be successful in doing that. We still have a long way to go. There will be many more cases, but we'll take care of that. And ultimately, as the president said, this will end. But what's going on here today is going to help it to end sooner than it would have. Thank you.
Thank you very much, Tony. If I could, some of these folks we know, they're celebrities in their own right. They're the biggest business people, the greatest retailers anywhere in the world, and one of them is Doug McMillan from Walmart. And I'd like to have Doug, if you would, say a few words, wherever you may be. Good. Doug, please.
When we got the call yesterday from the White House, we were eager to do our part to help serve the country. And given what we're facing, that's certainly important to do. We should all be doing that. So we've been asked to make portions of our parking lot available in select locations in the beginning and scaling over time as supply increases so that people can experience the drive-through experience that the president described. We'll stay involved and do everything we can from a supply chain point of view to be of assistance. Thank you, sir.
Thank you very much, sir. Appreciate it very much. I'll just stay right over here. And Richard, if you could come up, please. Richard, please. Walgreens, thank you.
Yeah. Thank you, Mr. President. And similar to Doug and Walmart, we're happy to stand in here and help in communities all across America, because a lot of times when we have natural disasters, our stores are a beacon in the community, and this situation is no different. So we look forward to partnering with the CDC, the administration, HHS, and the task force, and specifically to the vice president's doing such a fantastic job. We're ready to engage and help. Thank you.
Thank you very much. Great job. Thank you very much. Brian Cornell, Target. Thank you, Brian. Thank you, please.
Well, Mr. President, thank you for inviting us here today, along with our colleagues from Walmart and Walgreens and our partners at CVS. Normally, you'd view us as competitors, but today we're focused on a common competitor, and that's defeating the spread of the coronavirus. And we look forward to working with the administration to do our fair share to alleviate this growing threat. So thank you for including us today. In the near term, we're all committed to making sure we're keeping our stores open to serve the American consumer who's rapidly stocking up on household essentials, key food and beverage items that they need during this time, making sure we run safe stores and create an environment that's safe for our team members, making sure that they feel supported during this very critical time. So thank you for including us.
Thank you very much. Great job. Is Tom here? Tom Poland? Tom Poland, please.
Thank you, Mr. President. As CEO of Becton Dickinson, we're one of the leading providers of medical devices as well as collection products for testing of coronavirus. We're ramping up our manufacturing capacity to ensure that the right collection devices and testing equipment are ready to address this issue. Thank you, Mr. President.
Thank you very much, Tom. Great job you've done. Stephen Rakowski, Quest Diagnostics, please. Great job. Thank you very much.
Thank you very much. Thank you, Mr. President. So as mentioned, we were called with the leadership of the Vice President last week to come together as an industry. And we took advantage of that opportunity to work with the FDA, to work with the Center for Disease Control. And we are up and running with tests in a number of our facilities. As the President mentioned, we now have capabilities from Roche Diagnostics that we will bring into our facilities this weekend. And I know myself and us, my colleague at LabCorp will be doing the same. So the capacity available to the American public to support this action with consumers will be considerably increased in the next few weeks. Thank you, Mr. President.
Thank you very much. I appreciate it. Thanks. And Matt Sauce, please, of Roche. Matt, thank you, Matt.
Thank you, Mr. President. So from Roche, we want to thank the FDA for their rapid approval of our coronavirus test. We really appreciate the partnership with the CDC and the FDA to get that to market as fast as possible, because it's critical for us to make that available to help patients in need, and working with laboratories to get it up and going in the near future, which will bring hundreds of thousands of tests available to patients in need in the United States. So thank you.
And you can do it. You can do it. Great company. David Pierre of Signify Health, please. Thanks, David.
Thank you, Mr. President. We are the largest house call provider in the U.S., and we go to the homes of the most vulnerable elderly. And through our network and our logistics engine, we stand ready to help and provide our clinicians to be where they're needed, whether they're in retail clinics or in the home, and we're here to assist. Thank you very much.
Thank you very much. And we'll be changing a lot of the rules, regulations for future, should this happen in the future, which we hope it never does, but it will, I guess, somewhere out there. Some bad ones over the years, and I guess that'll continue to an extent, but we hope it never happens. But we're going to be changing a lot of the old rules and specifications and regulations. Adam Schechter, who's really been of tremendous help, LabCorp, please. Adam.
Thank you, Mr. President. At LabCorp, we're working every second of every day to increase the number of tests that we can run. We're working with academic medical centers, with our colleagues at Quest, with other hospital and other laboratories to ensure that we do everything we can to increase the testing as we move forward. And I can tell you, we understand how important the testing is, and we are committed to doing everything possible.
Thank you very much. Great job. Thank you. Thomas Moriarty, CVS. We all know CVS. Thank you. Thanks. Thank you, Thomas.
Thank you, Mr. President. We have been focused since the start of making sure our patients and the customers we serve have the information they need, the safety they need as well. We are committed to working with the administration and local public health officials to make this work as well. And thank you, sir, for the honor.
Thank you very much. Thanks. Great job. And Bruce Greenstein, LHC Group, tremendously talented people. Thank you very much.
Mr. President, thank you for the honor of being here. And the home health industry has been treating patients and seniors in the safety and comfort of their own home for decades. We're very proud to be part of the equation for testing in their own home. For Americans that can't get to a test site or live in rural areas far away from a retail establishment, we're here to help and to partner with our hospitals and physicians, as well as the people we have here today that will be doing testing around the country. Thank you.
Thank you very much. Good test. We'll practice that. Okay, I like that. That's good. We're also announcing the following emergency executive actions today. To help our students and their families, I've waived interest on all student loans held by federal government agencies, and that will be until further notice. That's a big thing for a lot of students that are left in the middle right now. Many of those schools have been closed. Based on the price of oil, I've also instructed the Secretary of Energy to purchase, at a very good price, large quantities of crude oil for storage in the U.S. Strategic Reserve. We're going to fill it right up to the top, saving the American taxpayer billions and billions of dollars, helping our oil industry and making us even further toward that wonderful goal which we've achieved, which nobody thought was possible, of energy independence. It puts us in a position that's very strong, and we're buying it at the right price. And that's something that would have not even been possible a week ago. The price of oil went down quite a bit, so we're going to fill it up. It's a good time to fill it up. I'd like to ask Mike Pence to say a few words, please. VP.
Thank you, Mr. President. It is this day should be an inspiration to every American, because thanks to your leadership from early on, not only are we bringing a whole-of-government approach to confronting the coronavirus, we're bringing an all-of-America approach. Mr. President, from early on, you took decisive action. You suspended all travel from China. You created travel advisories, South Korea and Italy. We screened all travelers from all airports in both of those countries. And on the unanimous recommendation of your health experts, you, at midnight tonight, will effectively suspend all travel from Europe and Americans that were returning will be screened and asked to voluntarily participate in a 14-day quarantine. Throughout this process, Mr. President, you put the health of America first, but you brought the best of America to address it. And it's not just at the federal level. As you said, Mr. President, we've been working with states across the country. We issued broad guidelines from CDC for every American. But this week, at your direction, we tailored specific recommendations from CDC for New York, Washington State, California, Massachusetts, and Florida. And we've been in continuous contact, as you said, with governors around the country. Mr. President, you have forged a seamless partnership with every state and every territory in this country to put the health of our nation first. But today, I trust that people around the country that are looking on at this extraordinary public and private partnership to address the issue of testing with particular inspiration. After you tapped me to lead the White House Corona Task Force, Mr. President, you said, this is all hands on deck. And you directed us to immediately reach out to the American business sector, commercial labs, to meet what we knew then would be the need for testing across the spectrum. And today, with this historic public-private partnership, we have laid the foundation to meet that need. For Americans looking on, by this Sunday evening, we'll be able to give specific guidance on when the website will be available. You can go to the website, as the President said. You'll type in your symptoms and be given direction whether or not a test is indicated. And then at the same website, you'll be directed to one of these incredible companies that are going to give a little bit of their parking lot so that people can come by and do a drive-by test. And Mr. President, I want to join you in thanking Walmart and CVS and Target and Walgreens. These are companies that are synonymous with communities large and small, where people come together.